Good morning, everyone. Thank you so much for joining today, our webinar on valuation and modeling. I'm super excited to talk with you all today about one of the most interesting topics in finance and certainly one of the sexiest. And so I just want to start out from the very beginning, understanding a little bit about why we even do this. Because a lot of people come to me and they say, okay, like, Max, I've got this interview coming up. It's for investment banking or for private equity or something like that, and like, or corporate finance, and I need to learn how to build a model. Well, and I say, realistically, especially for like investment banking, 99% of those interviews don't actually require models. And then they'll also say, oh, Max, I have nothing better to do, so I want to learn how to financially model. Just kidding, that one never comes up. And so there's the main point here is that there's like a little bit of a misconception that this is useful for the interview phases. And if you're interviewing for private equity, that's totally true. That is not a misconception. Happy to talk about that. But for three statement and traditional valuation modeling, it really doesn't come up for interviews all that much. And so, why are you here today? And why should you be here today on a Saturday morning, spending all of your time that you could be sleeping in, could be doing something a little bit more fun, especially if you're on the West Coast and it's bright and early there. Um, what are you doing and why? And realistically, it comes down to two things. The first is it cements your learning. And so financial modeling is the perfect way to aggregate all of the stuff that you've been learning in your other technical preparation and all the things that you've been understanding from your finance and accounting classes in school into one place where you're cohesively able to integrate these concepts in a beautiful sort of financial model and just like the consummation of your financial understanding. But the second piece is that it preps you for the job. And so financial modeling is one of those funny things that's like it's not required for the interview, especially for investment banking, but it is very much required to be successful on the job, to get those absolute top offers, and to make sure that you are the most successful person at your firm. And so, in order to actually do well at the job, you do need to prepare for it, and that is something that I highly recommend investing in. And so, my guarantee to you today is that if you pay attention, if you follow along, if you bring a little bit more camera on energy, so I'm not just talking to this wall of black names and things like that, and black screens and not seeing like what people are reacting to and things like that, and you just come with like energy and excitement to this as much as I'm hoping to bring, you will get those two things. You will learn and integrate a lot of the financial and accounting concepts that you've already been learning, and you'll be more prepared for whatever job it is that you do. Because virtually every job these days, regardless of whether it's actually in finance, is going to require you to have some degree of financial and modeling and Excel sort of understanding. So, with that caveat and with that understanding, let's jump in. My name is Max Adams. Great to meet you all. I'm super excited to be talking with you today. But my background comes from investment banking at Lazard and Catalyst after undergrad. Spent a couple of years there. Those are tech boutiques. Was in the San Francisco office because I am very interested in tech investing and tech investment banking. And then after, ended up going to Vector Capital, where I did technology private equity, and ultimately worked my way up through the senior associate and VP ranks. And then went off to business school at Stanford GSB and the Kennedy School of Government, where I am currently finishing up at Cambridge, Massachusetts right now. And so right now, though, most relevant to you is that I've been on both sides of the table of these interviews and building and assessing these models. And so I've coached, probably about 600 students up to this point in breaking into investment banking and private equity. And I'm hoping to give you a few of the tips that I've learned along the way as the head coach at Wall Street Mastermind. So, with that, let's talk about what's to come. We've got 4 hours blocked off on the schedule today, and we've got a packed schedule. So, first off, on the theory side of things, I want to cover three things. The first is an end goal. I want to center financial modeling in like what are we trying to do and why are we trying to do it? And so beyond the career stuff that I just talked about that's relevant to you, what ultimately is financial modeling for? And then second, I want to talk about the three statements. And so we've got the income statement, we've got the cash flow statement, we've got the balance sheet. And these three statements, like we need to make sure that we have a shared base of understanding on what these are and how they work before we're able to get into how to build them and why to build them. And then last but not least, we're going to cover valuation. This is the fun part. This is the part that everyone looks forward to, where we're going to talk about some of the distinctions between equity value and enterprise value, how we assess these things. We're going to talk about comps and precedents and discounted cash flow analyses. And if you haven't been familiar with these things in the past, you'll certainly emerge today with a baseline understanding. Then we're going to get into the Excel. And so this is going to be about 1 hour and could go a little over, could go a little under, and then we're going to get into Excel quickly. And so if you don't have Excel ready, if you don't have it downloaded, updated, all of that good stuff, let's get that downloaded. And I want to spend the bulk of our time building an actual financial model, basically as much as possible from scratch. We'll have some of the formatting in there, we'll have some of the templates in there. And so you won't be alone if this is the first time you've built it, but we're going to talk about collecting the actual data. We're going to talk about building an income statement, talk about cash flows, talk about balance sheet, and then we're actually going to create or look at the outputs if we have time to do so. Let's talk about the three things we're going to cover right now, which is we're going to talk about why we're building models. We're going to go through each of the three statements, and we're going to go into the valuation methodologies. With me so far? Let's start with the end goal. So, what is a financial model? Fundamentally, a financial model is basically a representation of a company's financial performance. And so it's not meant to be perfect, and it certainly never will be. But the only thing that we can hope for is that it's useful. And so we're trying to use financial models not to like predict accurately what's going to happen with the financial company. Because trust me, like on the inside, talking with the CEOs of these businesses, they're trying to forecast their financial performance. Like many of them have no clue what's going to happen in the next few months, let alone the next few years, because a lot of it relies on customers coming to them and buying and advertisements that could fail and things like that, and delivery that like could just randomly blow up and not work. And so there's a lot of stuff that can go wrong between predicting and actuality. But the process of building a financial model forces you to think critically about what could happen. And it's fundamentally necessary to engage in some of the transactions that probably you're hoping to engage in if you want to build a career in investment banking or private equity. And so it's a framework for thinking about assumptions. It's a tool, but it is not a guarantee of future results, and it is not actually going to create valuation without valuation analysis on top of the model. And so I want you to think about models as like, okay, a model of what the business does, and then also valuation that sits on top of that model and helps you understand what the worth of the business is. And so actually a lot of our focus today is going to be on that first piece. It's slightly less sexy, but fundamentally more important to understand what is the financial forecast of the business that we're building valuation based off of. And so my guess is a lot more of you have built a DCF or an LBO than a three-statement model. And that's backwards, unfortunately. So why do we do it? Well, it helps us answer questions. It's like, how do we make money? What matters? And like what happens in various scenarios? And it helps us make decisions. So we're able to make decisions on whether we want to buy or sell a stock, or whether we want to buy or sell a factory, or invest in different types of capital, make financing decisions, plan out strategy, and of course, value businesses. So let's take a look at what we're going to do today. We're going to be working with a public company called Sentinel One. Has anyone heard of this? I'm just curious, maybe raise of hands on the Zoom feature or something like that. Some emoji reactions. It's like a fairly prominent cybersecurity company. So it's a good one. Okay. Getting a couple folks that got it. Um, and so this is a really cool company that we're going to be looking at today and building a financial model for. And so you can see what this is going to look like. We've got revenue projections and a P&L here, the profit and loss statement. And then we've also got a variety of valuations that are built on top of that, starting with a football field that breaks down, okay, what are the different methodologies and the ranges we're building based off of? What do the comps look like? What do the precedent transactions look like? What does the discounted cash flow analysis look like? So the question is, what is the primary output of valuation? And so fundamentally, yes, it is correct. Like we are trying to create a value range. We're not trying to get a precise thing. It's just as close as possible as we can to something that makes sense. And so with that, let's jump into each of the three statements and make sure that we have a shared baseline of understanding of what goes into these things. So we'll start with the income statement. And so the income statement, as you know, is something that looks like this, that basically projects out how much money a business earns over time. And so you can see all the line items here, the revenue, the COGS, gross profit, sales and marketing, blah, blah, blah. Like we're going to go build this in Excel. And it looks a little intimidating right now, but once we hook up the underlying financial statements and talk about how to do projections for each of these things, it's going to make sense. It's not going to be too hard. So that's the income statement end goal. Let's talk about the components. Now, this might be a review for some of you, and I apologize, it's a very text-heavy slide, but I'm just going to talk through these concepts to make sure that you understand them on a deeper level. So first off is the revenue. This is the top line of the income statement, and probably the single most important metric in all of finance is like how much money does a business bring in from its customers over time. And so this is really important in financial modeling because we don't usually just say, okay, revenue, done, great. No, we spend like half of our time in a financial model forecasting the revenue. And now today we're going to do it a little bit simplistically, and we're not going to go into quite as much depth as you might otherwise. But for a SaaS company like Sentinel One, you would be building a very complex revenue waterfall. For a complex conglomerate like, Honeywell or something like that, you'd probably have 20 different revenue lines for each of the different geographies and each of the different business units. And you try and understand what are the fundamental underlying key performance metrics that drive revenue for each of these business units. Then, once you calculate the revenue and you sum up all those 20 different business units, you've got the top line. And then you've got to subtract out the cost of goods sold. And so this is the cost to deliver the actual services that you provided to the company or to the customers. And a lot of people, especially with tech, actually don't know what COGS are. Like, what is a cog for a business that, like Facebook, for example, that just like provides an app? Well, fundamentally, you've got to go back and think like, okay, what are the costs to actually deliver these things? And yeah, it's a lot of it is like data centers and like Amazon Web Services or their own server farms or things like that, and their customer support helpline that they like, theoretically, if something goes wrong with Facebook, you can submit a ticket or like reach out to someone and they can help. In reality, with Facebook, that's a bad example because it's very, very hard to get anyone on the line, but you get the idea. That gets you gross profit and margin. And so the COGS, once you subtract them out, gets you to basically the baseline profitability of when we sell something, how much of that do we actually get to keep? And that's really important to understand because a lot of businesses, especially very capital intensive businesses, sometimes they actually have negative gross margins. For example, when I was working in private equity, I did a multi-billion-dollar transaction with a space company, like as in like outer space, rocket ships, all that good stuff. And the company produced actual rockets. And in its history, like the first time that it built a rocket, it was very, very expensive to do so. It was very, very inefficient. They had to hire a ton of engineers. They had to build a ton of materials. They couldn't get economies of scale. They were testing things. They had to like, test out 10 different engines or something like that. And ultimately, their COGS actually were so large, they eclipsed the revenue. And so sometimes we actually get businesses where for everything they sell, they lose money. But of course, that's usually a short-term investment. And with this business, and hopefully any business in that situation, they were able to rectify that over time. Next up, of course, is the operating expenses. And so these are the costs to run the business. And so it's usually split into three categories. You've got the sales and marketing, you've got the G&A, you've got the R&D. And so in this case, for the sales and marketing, that's pretty self-explanatory. That's your sales reps, that's your head of sales, that's the commissions, all that good stuff. There's G&A, which is the general administrative expense. And so that's the cost to hire the CEO and the cost to pay your lawyers and things like that. And then R&D, which is the fun and the sexy bit, which is developing new products, developing new rocket engines, Facebook creating a new app, or like creating a Twitter threads competitor or something like that. And so the simplistic view then is you take the COGS, you subtract out the operating expenses, you get to EBITDA. Now, realistically, EBITDA can get a lot more complicated than what I'm showing here because there are often add backs where you have to add back non-recurring expenses and you have to make sure that there are like a steady state view of profitability is what you're going for. But then going back down to net income, we actually take EBITDA. So we go from operating expenses and then we subtract out a few more things to get down to net income. We subtract out D&A if it hasn't been added back already, if it has been added back already. And this is basically to represent the impact of like capital expenditures on the business. We'll talk a little bit more about that later. That gets you to EBIT, your operating income. And that's kind of an important metric in a business. Like EBITDA and EBIT are the two profitability metrics that we like the most. I'll bury the lead a little bit, or I'll tell you a little bit, which is basically that there's a lot of variability that happens between operating and net income. And so there's a lot of like random tax things, there's a lot of random interest expense and interest income, things like that that just aren't as relevant for every company and that change from company to company. And so there's a big delta between those that is idiosyncratic. It's not like related to the core operations of the business. And so if you're trying to compare businesses side to side, a lot of it's based off of EBITDA and EBIT. So in terms of a couple other concepts that we need to get out of here, and again, There's a lot of accounting rules, and so there's a lot of text. So bear with me as I talk with you about these concepts. There's probably going to be a couple that you're not as familiar with, even if you're an accounting expert. So first off, this is a flow metric. We're going to talk about some of the other statements that are as of a point in time, but the income statement is designed to show performance over a period of time. And so instead of saying, hey, this is, as of December 31st, it's at the top of the income statement. It usually says, hey, this is for the period of January 1st through December 31st. And so you know that that clock resets every single year. Second is that it's an accrual thing. And so accrual is basically a concept that says instead of measuring things like when cash comes in and out the door, we're going to measure things based off of this like nebulous concept of like when it's actually earned or when a cost is incurred or something like that. And that's a very sort of tricky concept that sounds simple in practice, but ultimately ends up with a lot of really, really complex accounting things that flow from that. And so it's like the concept of depreciation and amortization flows from that, and the concept of revenue recognition and expense recognition and accrued expenses and prepaid expenses. All of those stem from this idea that we're trying to create this fictitious world of accrual. And as a result, that creates a lot of assumptions. And so some of the key assumptions you're going to see that can materially determine the output of a business's P&L is like, what do you do with revenue recognition and depreciation schedules? Do you capitalize an expense or do you expense it? Do you have stock-based compensation? How do you think about taxes? All of those can be manipulated by management teams to affect your underlying and reported earnings. And that's actually a pretty common question in investment banking interviews, is understanding some of those technical concepts that management teams can manipulate in order to change their reported earnings. Then we've got operations and financing. And so operations versus financing, what we've got here basically is we've got this like mix between the operational stuff at the top of the income statement. So that's, all this stuff at the top here, everything above EBITDA. And then we've also got all this stuff down here, which is like related to the financing. And so we've got like interest expense and interest income and some of these like other random non-operational things that are a little bit less relevant. Another concept is margins versus absolutes. And so we actually tend to look at businesses comparably on a margins basis. And so instead of saying, okay, let's compare Apple and Google, because probabilistically one of them has billions and billions and billions of dollars more revenue than the other, we would say, okay, let's look at them on a margins basis. And so we're not going to say who has more gross profit. We're going to say who has a greater gross profit margin. We're not going to say who has more EBITDA. We're going to say who has a greater EBITDA margin, not who has more revenue, but what is the percentage growth rate and how does that compare? And so by using margins, we create a level of abstraction from an income statement that enables comparability. And then beyond that, we also, I'm just going to briefly touch on the order. Like we forecast the income statement first because it drives cash flow and the balance sheet. And so we kind of need to know what's going on in the income statement before going to the other financial statements. And as an investor and as an investment banker, I can attest that honestly, a lot of your time is spent with the income statement. In some ways, it is the first among equals. All of them are important, all of them are useful, but the income statement is probably the thing that you focus on the most in finance. So, with that, take a second and answer the common question of how does the income statement flow through to the other questions, other statements. And I want you to think through and see if you can come up with anything that I haven't written down at the bottom here. But the most common places where it flows through is net income goes to cash flow from operations, net income goes to retained earnings, and then a lot of the things like COGS are related implicitly to working capital. So that's the income statement. And I'm just going to do a quick pop quiz here to make sure that we're following along, understanding everything. So the simple question is, which metric best isolates business performance from financing? Is it one, net income, two, EBITDA, three, cash flow from financing? And then advanced, what can make each of these metrics misleading? And so talking through these, like it's not a net income because net income fundamentally is dependent on the capital structure. And so the financing like is intrinsic to what happens in net income. With EBITDA, it's actually a pretty good metric. And so that's the answer here. But you could also make a case for cash flow from operations or something like that. Now, cash flow from financing, that's just a little bit of a red herring. Fundamentally, that's not an important part of the cash flow statement relative to cash flow from operations and cash flow from investing. Let's move on to the second statement, which is the cash flow statement. I also just want to do a quick pulse check on pacing here. So let's go through and talk about the cash flow statement. And so on the cash flow statement, basically what we're trying to do is understand what the cash actually looks like going in and out of the business. And what you'll see here is that this is actually a pretty non-traditional cash flow statement that we're going to be building today. We're not including cash from operations, cash from investing, cash flow from financing. All we're doing is projecting out the pieces that we actually need in order to build the model. And so, funny enough, like if you go look at a 10K for a business that has, it's got all these sections, and it's, 100 pages long, you've got this cash flow statement that has, operations, income, blah, blah, blah. It's like we actually don't build that usually when we're building financial models. Like sometimes you do, but most of the time when you're, a private equity associate or something like that, you don't got time. Like who cares? You're only going to project out the actual pieces that are most relevant for you. In this case, it's going to be like current assets, current liabilities, some net working capital concepts. So let's talk about these concepts in a little bit more depth. So the cash flow statement, you got three main buckets. You've got cash from operations, cash from investing, cash from financing. You know this. So cash flow from operations is basically trying to approximate what does the operational generation of the business look like. And so from selling things. And so if you're Apple, it's like how many iPhones do you sell and like what cash does that generate after you pay your distributors, you pay the shipping, you have these containers going back and forth from Shenzhen, like yada, yada, yada. That's probably the most important part of the cash flow statement. And the way that it works is you start with the net income. So you're using the net income from the income statement as the baseline. But then you're adjusting things up and you're adjusting things down. And so the things that you're adjusting up are like non-cash adjustments. And so there's a lot of expenses that are on the income statement that we've got all that accrual crap going on where they're not actually cash going out to people. And so if I'm paying for my iPhone that I'm selling to someone in Cupertino with credit, then like fundamentally that's not a cash expense. Like I'm not taking out my wallet and giving them money. I'm just giving them an IOU. And that's not going to go into our cash. And so we've got to adjust for that on the cash flow statement. Now, the other thing that a lot of people don't realize, though, is you do have to adjust for cash expenses that aren't on the income statement. And so common things like this is, sometimes there's something that like you incur as an expense or that you're paying for that doesn't show up on the income statement due to like timing differences. And so, for example, if you pay ahead for the next 100 iPhones, but you haven't sold them yet, then that's going to show up as like a use of cash on the cash flow from operations. And so a lot of that is baked into these non-cash adjustments and these working capital changes that I just described. And so working capital is probably the most important concept that people get tripped up on with the cash flow statement. And the reason for that is because it's very complex to understand, like if my accounts receivable increases, is that a source or a use of cash? If my accounts payable decreases, is that a source or use of cash? And then once I have my net working capital, which is my current operating assets minus my current operating liabilities, if that increases, is that a source or use of cash? And if that decreases, is that a source or use of cash? And so we'll get into that a little bit as we build out our cash flow statement. But that's going to be something that I'd really encourage you to pay attention to and challenge yourself. And in fact, a lot of my students that I work with, I encourage them to write out a grid. And it's got three lines and a couple columns. So the columns are increase, decrease, and the lines are current operating assets, current operating liabilities, net working capital. And I want you to think through, if you're a little bored here, say, what happens if my current operating assets increases? Or what happens if the current operating liabilities decreases or something like that? That's going to be really, really important. Then cash flow from investing. We've got basically capital expenditures, we've got acquisitions, we've got all of these things that are used to invest in the long-term future of the business. And then cash flow from financing. We've got all of the things that you're using to finance the business and the equity raises, dividends, stock buybacks, and things like that. And so what you're probably noticing right now is that what I'm describing in words here looks very different than what I just showed you on the previous slide. Like this looks a little bit like a balance sheet, right? Well, yes and no. But again, remember this piece at the bottom that we actually only forecast the parts that we need. And so the parts that we need for our model that we're building today is like we don't actually need to focus on forecasting out like cash flow from financing, like the debt issuance and repayment and stuff. Like we can make some simplifying assumptions that are reasonable for the purposes of model. So you don't actually need to forecast out cash flow from financing. And if this doesn't make sense right now, we're going to go into more detail when we're actually building the Excel. And so if this is confusing right now, hold your horses. It's going to be totally fine. We'll go through this in much more detail about why this doesn't quite look like what you've probably seen in your other financial models for a cash flow statement. And then next up, let's talk about a couple other concepts on the cash flow statement. So some concepts here. First off, flow. So realistically, this is a flow measure. Again, not a point in time measure like a balance sheet. And so we're looking at how does the cash change over time. And our goal here is to figure out like what is the actual cash reality of the business? Like is cash increasing? Is cash decreasing? Why or why not? And so a key piece here is reconciling the income statement to what the actual cash reality is. And so we start with the net income, which kind of makes things more complicated in some ways. Like there's a version of the world where you could build a cash flow statement based off of just saying, okay, here's how much cash we collected from customers, here's how much cash we paid for suppliers, bing, bada, boom, we're done. That would be very, very simple. And in fact, a lot of businesses, especially small businesses, operate that way. Like, I don't know if any of you, like, I don't know if your family has a small business or something like that. I ran a canoe rental business when I was in college, in high school, actually, to pay for college. And I did not do any sort of accrual-based accounting. Basically, what I did is I had a spreadsheet where I tracked, okay, how much cash am I generating for my customers? And I tracked how much cash I'm spending on buying new canoes and renting them out to people and things like that. And so it was very, very simple. And I didn't actually have an income statement. All I had was a cash flow statement. And that was good enough for my business. Now, as you get more complex as a business, though, there are different components to the cash flow statement. You've got operations, you've got investing, you've got financing decisions that aren't always applicable for small businesses, but are very much applicable for larger businesses that have complex capital expenditure structures and complex financing structures. A couple other things I'll just talk about here is that basically the context does matter in terms of how you're thinking about this. And we've got to make sure that you're able to reconcile these concepts very, very well. And so I'm going to move forward from here. There's a lot more that we need to talk about, but let's get into the weeds of actually building the Excel model, and more of this will make sense. So, pop quiz here. Let's talk about what cash flow from operations actually answers. Does it, one, answer whether the business generates cash, two, if the company is profitable, or three, how the company is financed? But the more advanced question here is why can CFO be negative in a healthy, fast-growing company? Think through what are a couple of reasons why that could be the case. And so picture a business that sells, I don't know, that like resells Birkin bags or something on credit or something. And so you've got a bunch of customers who are coming to you and they're buying these Birkin bags and they say, okay, I'll pay you 3 months from now. You know, I'm going to pay you every month for a few months or something like that. And you say, oh, that's great. Like happy to do that. But then if you're buying the Birkin bags from your supplier in cash, then like fundamentally that's going to be a huge cash outflow for cash that's going to come in the future. And so you're going to have this cash crunch where even if it's a good growing business and you're generating a lot of sales and stuff like that, you could technically go bankrupt. That's probably the most common version. But there's also other things like capital expenditures and that I guess would go into cash flow from investing and like other working capital dynamics. You could have like strange like one-time liabilities, like for example, if you had like a write-off or something like that, or well, I guess like your factory burned down or something. Like there would be potentially some operational things, and I think I'm throwing out some bad examples here, but there are many different things that could happen in the cash flow from operations that would create a really bad cash flow dynamic. So with that, let's keep plugging forward. I'm so excited to get you all into the Excel model. And so I'm pushing forward at a pretty good clip here. We've got to cover the balance sheet. We're going to discuss some stuff on valuation, and then we'll get you into Excel as soon as possible. So balance sheet, let's talk through this. This hopefully looks a little bit more like what you're actually expecting from a balance sheet as opposed to that abbreviated cash flow statement that I was showing earlier. And so the balance sheet here, fundamentally, you've got assets equals liabilities plus equity. And this is a very, very simple balance sheet that we've got here. We've only got a half dozen line items. Now, in a real financial statement, balance sheets can be an entire page of like line of text. And it's got like 30 different types of cash and 30 different types of accounts receivable and goodwill categories and PP&E categories and things like that. And a dozen different like random things in the cash or like the retained earnings and APIC and other sections at the bottom. And so it's really, really complicated in real life. And so part of a financial model's goal is to squish all that down into the stuff that actually matters. And so we've got the items that actually matter here. Let's talk through them. So the first one is your cash and cash equivalents. And so at the top, that's almost always the first line item in a balance sheet. And this is a pro tip for those of you who use modeling and like pull down financial statements, 10Ks and 10Qs to model. I almost always search for cash and cash equivalents, like a control F cash and cash equivalents, to get to the balance sheet quickly in the financial statements. And this one's pretty straightforward. It's what liquidity you have on hand. Now, next up is accounts receivable. And so this is basically, again, the revenue that you've earned but not collected. It's kind of the opposite of deferred revenue, which is revenue that you've collected but not earned. And so one of those is an asset, one of them is a liability. It can be current, it can be non-current, just depending on whether it's collectible in a year or less than a year. Then inventory, everyone knows what inventory is. This is like the actual stuff that you hold for sale and production. And for a lot of tech companies, that's basically zero. And a lot of services business, that's basically zero because you don't have inventory. You're not selling physical goods. You're selling minds and capital and like ideas and things like that. And then other current is prepaids and short-term items that are going to convert in the next year. And so again, like there's this concept of current and non-current that we'll talk a little bit more about, which basically indicates, is it going to be relevant in the next year or is it going to be years and years from now? Next up is PP&E, property, plant, and equipment. And so this is what a lot of people think of when they think of business. They think of like a big factory with smokestacks and, stuff coming in and stuff coming out and trucks and going back and forth and things like that. That's the classic quintessence of like a physical business is PP&E. For a lot of software businesses and services businesses, there's not much. And so in fact, for example, for a law firm, like their PP&E would be like, a few $1,000. It'd be like a desk, a chair. Maybe they buy someone's laptop or something like that, and that's part of their PP&E. But they're not going to have actual factories and whatnot. And then intangible assets and goodwill. This one is a little bit of a complicated one. You can get intangible assets and goodwill from M&A. You can get it from like acquiring intellectual property. You can get it from like developing intellectual property. And so there's a lot of ways that this one comes about, and it's usually pretty hard to forecast. And so one of the first things that we'd usually just hold flat in a balance sheet forecast is something like intangible assets and goodwill. And then on the liability side, we get into some things like accounts payable and accrued expenses. And so accounts payable being all the stuff that you owe to your suppliers for them delivering the goods to you and delivering whatever it is that they deliver. And then you've got the accrued expenses, which is all the stuff that you've paid or that you have to pay for that you haven't paid for yet. And so you've got your utility bills stacking up for your office in downtown Manhattan. That's an accrued expense that you've got to pay off. And then we get into the deferred revenue, talked about that briefly. A good example of a company with deferred revenue is Netflix. I don't know if anyone has a Netflix subscription where they like pay for a year in advance and then they continue to use it throughout that year. Basically, Netflix recognizes a huge amount of deferred revenue because they collect all this cash up front and they give you a little bit of a discount for that. And then over time, they actually haven't earned it. And so we can talk a little bit more about that. That's a very fun concept about like why businesses do that. But fundamentally, it creates a really good cash flow dynamic for Netflix where they have tons of cash, but they do also have a liability to earn that cash later on. Now, at the bottom of the balance sheet is the equity stuff. And so this is common equity, this is retained earnings, this is APIC and other. So the common equity is pretty clear. It's basically just like how many shares you issued times the par value per share. Now, a common mistake with common equity is people confusing it for market cap. So take a second and think through this. If you haven't already like realized that distinction, the balance sheet equity has almost no bearing related to like the actual market value. And so if we were to go back and look at Apple, for example, like the equity on their income statement or on their balance sheet is probably like somewhere in the range of like a couple $1 billion. Like I don't know exactly what it is, but it's very small when you're looking at a trillion, multi-trillion dollar company. I think their market cap is like $3+ trillion. And so there's 1,000x difference probably on their balance sheet. And that comes because this common equity here has nothing to do with the market cap. It's simply the amount of issued stock at the par value at the time of issuance. And then there's the retained earnings, which is kind of the accrued amount of earnings generated over time. It's a metric of like cumulative profitability. And so this is not comparable across companies because a company that's been around for 50 years, like Apple, is probably going to have way higher retained earnings than some SaaS startup that's also extraordinarily profitable. And then last but not least, we've got APIC and other. Now, this is fairly complex and nuanced accounting concepts that play into some of these pieces at the bottom of the balance sheet. And so I'd encourage you to go take a couple accounting classes if you want to learn about that. But like realistically for financial modeling, we don't pay too much attention to this. So that's the balance sheet. There's a couple other concepts we need to know. So in contrast to the cash flow statement and income statement, it is a snapshot. And so you can have a balance sheet as of, January 31st. You can have a balance sheet as of February 1st. You can have a balance as of February 2nd. And it's like it will make sense and it will look about the same as it did the day before. And so it's not going to be over time. It's not going to reset. It's sort of saying what is the actual stock value of these assets and these liabilities at any given point in time. Second thing to know about the balance sheet is the fundamental equation here, which is that assets equals liabilities plus equity. This must always balance or the model's wrong. And I can't tell you how many models I've built where it's just like so close, but not quite right. And your managing director or your boss or whoever you're working with, if you're building a balance sheet, isn't going to let you get away with so close, but not right. And so you'll probably actually spend a lot of time if you are building models with balance sheets trying to reconcile those last little bits of connectivity because it kind of is the last thing that synthesizes all the assumptions that you made on the income statement and the cash flow statement. So if the income statement is like, 3 out of 10 complex, then the cash flow statement to reconcile everything to the income statement is going to be like 6 out of 10 complex. And then the balance sheet, in order to reconcile everything between the income statement and the cash flow statement, is going to be like 9 out of 10 complex. And so the complexity of the income statement and the cash flow statement is magnified in the balance sheet modeling. That's going to make it actually very hard to make your balance sheet balance. And so we're going to talk about how to do that today, but that's part of why we make simplifying assumptions and why we keep it as lean as possible. Because with financial modeling, you don't want to be complex. You want to be as simple as possible to get the ideas out that you're looking to get out. And so for this, fundamentally, we're trying to understand like what is the state of the business's finances at any given point in time? Like, are they liquid? Are they solvent? Do they have cash to pay for things? Are they going to go bankrupt because they've got a huge amount of debt? Like, what's going on with the working capital and the capital intensity, retained earnings, things like that. And it's really not that comparable across firms. And so, don't look at the balance sheet of one company and expect to learn something about a company that's different than that. Now, last but not least, how does it connect? Well, similar to the income statement and the cash flow statement, they're all interconnected in a lot of beautiful ways. It connects through net income flowing through retained earnings. It connects through cash coming from the bottom of the cash flow statement. It connects with debt coming related to the cash flow from financing and also related to interest and interest income and interest expense on the income statement. You've also got working capital that's going to impact the cash flow from operations and the income statement. So the balance sheet in some ways is the most important in the sense that it's like the most interconnected of the statements, but also the most complicated. And you might be wondering a little bit like, how did people actually come up with this? Like, why did we do this way? And a lot of it is just organic over time, where accounting rules became formalized over the course of the 20th century as businesses looked at their income, they looked at their expenses, they looked at their accounts, and they tried to find ways that were useful to them to understand the performance of businesses. Now, what's funny is like in the modern economy where businesses have changed and we're not working with the robber barons Standard Oils of the 1870s anymore, and we're working with the Facebooks and the Metas and the Googles of the world that have very, very different financial profiles. Like a lot of the concepts of accounting have become less relevant. And so it's funny to say, but like a lot of the time when I'm an investor looking at a business, like I don't really care what net income is. Like I just don't care. Like I do not spend time thinking about net income or earnings per share or things like that. Public investors might, but for me, I only care about the EBITDA and like the cash flow, unlevered free cash flow of the business and things like that. And so there's a little bit of a mismatch between like what finance professionals actually use and what accounting professionals actually provide. And so part of the difficulty of being a finance professional is taking what the accounting professionals give you based off of like this whole historical chain of like trying to create something useful and something standardizable and something valuable and interesting, and then reconciling that to what you actually need. And that's why models are so complex and why we can't just like look at a company's financials and be like, I need to know everything I need to know. You've got to take those financials, adjust them, massage them, adapt them, present them in new ways, and then get to something that's actually useful for you as an investor. So, quick quiz on the balance sheet. Retained earnings primarily reflecting the cash balance, the cumulative profitability, the market performance of the business. I'm making these way too easy. They're going to get harder next time. So the more advanced question here is why is the balance sheet so hard to forecast? I talked a little bit about this. Yeah, so let's talk through this a little bit. So retained earnings is not really related to cash. Like it does have some semblance of relation because if you're not generating a lot of net income, you're not going to be generating a lot of cash, and therefore it's not going to flow through net income to retain earnings. But number two is the more correct answer here because basically what we're doing with retained earnings is we're saying, okay, what was the net income in year one plus the net income year two, year three, year four, year five, less whatever dividends we pay out. And so the formula here that you need to remember if you're interested in answering this question correctly in interviews is retained earnings is the cumulative net income minus the cumulative dividends of the business. Now, market performance, again, this is a common mistake that a lot of students make is they think that there's a relation between what's on the balance sheet and what financial markets actually say the value of a business is. And so fundamentally, there's huge discrepancies between those two things, especially for companies that have been around for a long time. And so even if you're looking at like the assets of a business relative to its market cap, it's very, very different. Looking at the equity value of a business relative to its market cap, very, very different. And so don't fall into the trap of thinking that the balance sheet items are going to be meaningfully related to what you're seeing in public markets. And that's just another reason why the balance sheet and like these financial statements aren't always super relevant. We've talked about a lot of things already. We've talked about why we build financial models and why you should individually care about building financial models. We've talked about the three statements. We've gone through the income statement, cash flow, balance sheet. And so we're hopefully all at kind of the same level of understanding conceptually what these are and why we do them. Now let's talk about valuation. And so this is the why. We've got these components, we've got these statements, we understand them. Now, what are we doing with them? Like, why did we just go to all of that trouble to create an income statement, a cash flow statement, and a balance sheet? Let's talk about that. So, what is valuation? Well, it's the process of figuring out what something's worth. And there are a lot of different ways to think about it. So we've got relative and intrinsic. I'm looking for something a little more concrete. What are the two different metrics that we use to actually say here is the value of a business? Not how do we measure it, but what are we measuring? Enterprise value and equity value. So let's talk about that. So enterprise value here, many of you probably know this, but it's hard to understand conceptually what the difference is here. So enterprise value is the value of the entire business that's available to all of the capital providers, so the debt and equity, and it's independent of capital structure. Like we don't care how we got there, we just care what is the value of the business. And so in some ways, this is the more important metric. But it's also the metric that we spend less time talking about. Like most people, when they say, okay, what's a business worth? They'll say the market cap, and they'll say the equity value. They'll say something other than that. And that's because that's what's publicly investable, and that's the part that's accessible to us as individuals on our Robinhood accounts and things like that. But fundamentally, that is not the more important valuation metric. The formula here, if you're curious, I'm sure most of you know this, is basically just equity value plus net debt. Now, more complexly, we add in preferred stock, we add non-controlling interest, we subtract out non-operating assets. Like there's a lot that goes into it, but it's actually fairly simple at the end of the day, which is we're saying, okay, whatever the equity value holders play plus whatever other forms of capital are coming into play. And so the equity value here is the value to the outstanding shareholders or the common shareholders only. And so it's a subset of enterprise value that's associated to the people who put in cash in order to receive future cash flows of the business. And that one is share price times fully diluted shares outstanding. Now, that sounds simple. In some ways, it is. But in practice, for those of you who are a little more advanced, I'd spend some time thinking about how do you get to the fully diluted shares outstanding because you get into complex things like options and warrants and restricted stock units and convertible debt and things like that. And then, call options on like your convertible debt and things like that and covered calls and whatnot. And so there's a lot of complexity that actually goes into the fully diluted shares outstanding. So for those of you who want to go a level deeper, spend some time looking into that and trying to calculate the fully diluted shares outstanding of your favorite public company as a good exercise. Let's build some intuition though. So fundamentally, when we think about enterprise value versus equity value, the enterprise value of business is like a house. And so let's say, actually recently I did a deal where I purchased a piece of land in Nevada. And the land, it's nice land. It's got a pretty view of the mountains, like whatever the case may be. And so it's worth X dollars. Let's say that's the land I bought was worth about a $500,000. It wasn't actually, but like let's just say that. And so that's the enterprise value of the house. Like that's the value of the assets. Like you can go camping there, you can look at the mountains, you can do whatever the heck you want to do on this plot of land. Like it has value. And it has potential future value. Like maybe it'll get developed for real estate, or for like housing, or for solar power or something like that. So there's a real enterprise value of like the asset of this thing. How I pay for that is entirely separate. As it so happens, I actually did this deal with entirely equity. And so it was 100% equity. It was sort of like if this orange bar of this land in Nevada was $500,000 instead of $400,000. But like realistically, I could have gone to the bank and I could have like taken out some debt and like financed against the land purchase. Or I could have gone and like taken out some bank debt and like, gotten a couple of other people to lend me money or something and gotten like 90% debt or something. Or I could do 50-50. Fundamentally, the enterprise value of this land that I purchased in Nevada stays the same. My share in it changes a little bit, and like what cash flows I'm entitled to changes a little bit depending on how I finance it. And so that's a very like individual decision for each business of like how they want to finance the purchase of their assets. And for me, since like this land, like it's not monetizable yet, like I haven't built anything on it, I haven't done anything with it, that would be really stupid to go and take out debt because then I would have to pay that debt out of my own pocket personally because the land is not generating cash flow that could be used to pay down that debt. Now, conversely, let's say that I had purchased, a land with like an apartment complex on it, and I was renting it out, and that was great. And there was like a lot of, cash flow coming in from the people that were, renting these apartments. It was great. Then I could take out a lot of debt and use that cash flow to pay down the business. And so fundamentally, the business stays the same, the asset stays the same, the land that I purchased stays the same in terms of value. The financing mechanism can change. And so, one quick hack on this, by the way, for those of you who are doing any finance interviews, is when people ask you what is the impact of XYZ thing to enterprise value and equity value, always ask yourself, did the business itself change? Like, did I cut off some of the land? Did I build an apartment building? Did I get new renters? Did I, did the building burn down or something like that? That's going to change enterprise value. Everything else won't change enterprise value. So, what drives this? Like, what actually makes Apple worth 3.2 trillion or something like that, and Google worth like 4 trillion or something? Well, three things. First off, free cash flow. Second, growth. Third, the discount rate. And so these are the drivers of valuation. And so the free cash flow is basically saying, okay, how profitable is this business? And so let's say that Google and Apple both generate $100 billion of revenue or something each year. Um, if one of those has 50% profit margins, the other has 10% profit margins, one of them's all else equal going to be 5 times more valuable. The second is the growth. If both of them are generating $100 billion of revenue this year, but one of them is going to generate 200 or 300 or 400 billion next year, then we know that there's going to be like growth. And then last but not least, how risky are those going to be? And so if Google is betting its entire, future of the company on Gemini and then Gemini doesn't like succeed very well for those of you who are following the AI battles right now, then like that's going to be hugely risky and potentially going to be much more like a much higher discount rate than like Apple, which is just going to continue to sell iPhones and they're going to continue to sell MacBooks and things like that. And it's like probably pretty de-risked. And so the WACC for one of those businesses might be higher than the WACC for another business. And the WACC for both of those is way lower than like the WACC for some random AI startup that just got founded down the street. And so free cash flow, prospects for growth, and WACC are all kind of trade-off levers that we think about when valuing a business. And sometimes you get businesses that are extraordinarily profitable. Often they're not growing as fast. They're pretty stable. The risk rate is low. Sometimes you get businesses that are growing extremely fast and way risky, but often in order to do that, they have to pay a lot of cash and their free cash flow is super low. And so what you can't do though is you don't want to invest in or buy businesses that are not profitable, that are not growing, and that are extremely risky. That's just a bad idea. And so if you can get one or two of those three things, then it might make sense. If you can get three of three, you've got a great investment on your hands, assuming the price is right. So those are the drivers. How do we measure it? Now, this is what a lot of you were talking about earlier when I was asking, how do you think about like valuation? You're saying, okay, how do we actually measure it? Well, there's a few different approaches. There's market, there's intrinsic, and then there's some other things. And so on the market side of things, the two most common are public comps and precedent transactions. On the intrinsic side, it's mostly just the DCF. And then there's a bazillion other ones. There's LBOs, there's liquidation analysis, SOTP, ACTIL, NAV, other things. And like some of these are, a little bit markety, a little bit intrinsic. Like we don't need to get into that. But our focus today is going to be on the three major valuation methodologies. Now, you might say, why am I not including an LBO? LBOs are weird. They're not actually a valuation methodology. Fundamentally, what an LBO does is it tells you what your return is going to be if you invest in something at a given price. And so in private equity, I build LBOs all the time. I love LBOs. They're great. We're going to do a boot camp on LBOs next month. But they're not actually valuation methodologies because you're saying, okay, here's the purchase price, which I'm just assuming. I'm assuming like, hey, I'm going to go buy this business for $1 billion, and then I'm going to pay down the debt. I'm going to increase the cash. It's going to be great. And then I'm going to sell it for 2 billion. I'm going to generate a 2x return. Simplified example, that's what an LBO is. And you'll notice that at the beginning, I assumed what the purchase price is. I said, I'm going to buy this for $1 billion. Like, how do you get that $1 billion? Well, that's where you actually have to go to real valuation, which is the market and intrinsic valuation approaches. You got to go do the comps, you got to do the precedents, you got to do the DCF. Otherwise, you're not going to even know what to pay for the LBO. So, pop quiz on the valuation. Now, this is the last thing standing between us and Excel. So, quick question here. Enterprise value represents one, valued equity holders, two, market cap, three, value of operating assets. And then the more advanced version of this question is why do we add in non-controlling interest into total enterprise value? The market capitalization is a synonym for equity value. So market cap equals equity value, and that's the value only to the equity shareholders, not to all shareholders, like enterprise value. And then as we think through why non-controlling interest is added into enterprise value, we basically need to make sure that in general, we're including the entire value of the operations of the business, regardless of who actually owns them. And so the way I think about it is this land deal I actually did with another investor. And so I purchased this piece of land in Nevada with another investor. And let's say that I did 80% of the deal and the other person did 20%. When I look at the value of the land, it's still worth 100%, even though I contributed 80% and the other person contributed 20%. Not the actual numbers, but like you get the idea that we would need to add in my component and the other person's component to get up to 100% of the value of this like asset that I purchased. If I were just looking at the 80%, that'd basically be my equity value. It wouldn't have anything to do with enterprise value. And so you've got to make sure that you're consolidating all the little pieces of the business that are owned by other investors into your actual enterprise value. And this actually gets pretty complex because for businesses like Apple and Google and Microsoft that have hundreds of investments in different businesses and they're doing complex deals where bits and pieces are getting sold off constantly for 100 different reasons, you have to make sure that when you're calculating the actual enterprise value, you go and you consolidate all of that back together. So in this one, the answer is number three, of course. Most of you got that correct. And a lot of you were able to add really interesting things about why we add in non-controlling interest. Give me 5 more minutes here to talk about the actual methods themselves, and then we'll get into Excel. So first one is comps. So again, we're going to talk about comps, we're going to talk about precedents, we're going to talk about DCF. So the comps that we're going to look at today look something like this. You got a list of peers, you got some multiples, and the part that you actually care about here is really only two or three numbers. You care about the mean and median revenue multiple and EBITDA multiple. 90% of the time, that's that. And in this case, the mean and the median are a little different. And so you actually probably do need to like pay attention to like, is this going to be 6.5 times? Is this going to be 8.5 times? Is it going to be 20 times or is it going to be 30 times? And how we decide like what multiple to apply to the business, we'll get into a little bit when we talk about football fields. But let's talk about comps first. So the concepts that you need to know with comps is like fundamentally what we're trying to do here is we're trying to value a business by looking at its peers. And so going back up here, the company that we're looking at today is called Sentinel One, and it's a cybersecurity company. And so it like helps you protect your cybersecurity assets, your cloud computing environments, your endpoint environments. And it compares to companies like CrowdStrike or Palo Alto Networks or SentinelOne, Fortinet. If you haven't worked in the software or technology industry, you might not have heard of any of these businesses before. But my guess is you've almost certainly used their services and you've almost always like are interacting with them on a daily basis. You just don't know it. And so when we look at comps, fundamentally the challenge that you have as an investor or an individual is trying to understand if the businesses that you're picking are correct, and then figuring out how comparable they actually are. And so you've got to make sure that you're going through and looking at the other businesses and saying, hey, like, is it appropriate to compare Google and Apple together? Because both of them sell phones, both of them have a lot of software, both of them have a lot of consumer users, but one of them has a lot more search engines and a lot of the other one has a lot more hardware. And so is that going to be a good comp? Like maybe, but it's not going to be perfect. And so how do you determine if it's a good comp? Well, like yeah, the business operations, but you've also got to care about financial metrics. And so is the size and are the scale comparable? And so yeah, you've got Apple out there that's producing like fancy new phone or whatever, and then you also have like some startup in Taiwan that's probably also producing some really good phones. And one of them is a multi-trillion dollar company, the other is a multi-billion dollar company, like fundamentally very different thing. And so even if they do the same thing in terms of businesses, you're not going to be able to compare them. Now, question for advanced folks watching this is, do you actually give a higher multiple to a company like Apple or to a smaller company that has less scale? Like basically, do the multiples change based off of scale? And how do they change? I won't answer that right now, but let's go into some of the other things that you look at. So with growth profile, you've also got to look at growth. Like basically, which of those companies is growing faster because whoever's growing faster is going to have a higher multiple. Which one's more profitable? Whichever one more is profitable is going to have a higher multiple. And a side note on this, for those of you who are interested in public markets and how they shift over time, the difference between growth and profitability actually really changes on a yearly or decade basis, where sometimes investors they give higher multiples to businesses that are growing really fast and unprofitable, and sometimes they give higher multiples to companies that are really profitable but not growing as fast. And so there's a little bit of a trade-off and a tension between those two things, where at different times market sentiments are going to reward each of those things differently in terms of the multiples that they achieve. You've also got to look at capital intensity. Let's say that we've got Apple, which produces smartphones, and you've got Foxconn, which is their contractor that actually produces the smartphones, and Apple just pays Foxconn. One of those actually has to build factories. The other just has to build an office building so that people can design the iPhones that are built in those factories. And so even though technically both of them are involved with smartphone manufacturing and both of them are very large, very successful businesses, one of them has a huge degree of capital intensity, the other doesn't. Risk profile, cyclicality, customer concentration, regulation, geographic exposure. Like there's a ton of different things that can make one business really, really good and another business really, really poor. So for example, let's say we have Apple and Apple 2.0. They're the exact same business, exact same revenue, exact same profitability, exact same scale, whatever, same growth prospects. And one of them is in the US and one of them is in like a very dubious nation with poor regulatory environment and like bad capital controls and potential for a military coup in the next couple of years. Like that business is going to be worth a whole lot less because you're implicitly saying that the WACC is higher, the weighted average cost of capital, the discount rate. Then beyond that, we've got to make sure that we're looking at a neutral capital structure. So this is something that is really important is to make sure that you're looking at enterprise value metrics, not equity value metrics, and that you're looking at underlying denominators that are related to the actual capital structure of the business so you can compare apples to apples. And then also you want to make sure you're looking at things on the same time period. SentinelOne, the company that we're going to look at today, is interesting because it has a different fiscal year than a calendar year. And so you've got to make sure that these are equal across different methods. Now, for the sake of time, I'm going to skip the last couple takeaways here so we can talk about precedents. Now, precedents are kind of funny because they're basically the exact same thing as comps, but they're with deals that have already happened. And so it's like in the same way that like comps are an ever-changing continuous thing, this is a snapshot as of a point in time. What was the valuation of XYZ company on this date? And so you can see I've collected a half dozen different companies that did acquisitions at a given time for a business. And you can see what the enterprise value was. You can look at the revenue, the EBITDA, and the announcement dates. And fundamentally, we're going to boil that down to like what was the revenue multiple, what was the EBITDA multiple, mean and median. Now, what do we need to know here? Well, relative to the comps, It's kind of the same concepts. Like you basically just want to make sure that the company that was being acquired was similar. Like, did it do the same things? And you also want to understand like what the control premium was and what the impact was there. And so this is a classic interview question, but like in general, is the valuation of precedents or the valuation of comps going to be higher? And a lot of that comes down to the control premium, which is this concept of basically saying in order to acquire a business, we've got to pay more than whatever it's trading at. And so if I were to just go say, hey, CrowdStrike, I'm going to buy you for $144 billion in market value, they're going to say no, like hell no. You got to pay us a control premium. And so for that reason, the precedents, their multiples are often quite a bit higher. And that will vary based on whether they're a strategic buyer or a sponsor buyer. So for example, like let's look back at like the Instagram acquisition by Facebook back like a decade ago. You may not know this, but like Facebook actually didn't used to own Instagram. And so they actually had to go buy it. And they think they paid like, $1 billion or something, which is like one of the best deals of all time in retrospect, like such a stupidly profitable deal for them. But at the time, Instagram probably wasn't generating any revenue. They were probably like negative cash flow or something like that. Maybe they had a little bit of revenue or something. But like fundamentally, if you were to look at that, you'd be like, okay, like why would someone pay $1 billion for a business that's not profitable and not generating revenue? Like it just is stupid. And like a financial sponsor, like a private equity firm, wouldn't do that. And so the only reason that they had that massive $1 billion price tag was because it was a strategic buyer. And so when we look at these precedents that we have here, we've got to consider which ones were done by financial sponsors like Francisco Partners and which ones were done by like strategic buyers like Google Wiz. Also got to consider synergies. And so synergies are going to change the multiples slightly because you've got to adjust for the fact that like the EBITDA may be a little bit higher on a synergized basis than what you're seeing elsewhere. And then you've got to consider the market environment. Was it at the peak of a bubble? Was it in the middle of a depression? You got to consider the timing. Was this 5 years ago? Was this current? Was this basically like, are we looking at like LTM metrics? Are we looking at forward multiples? Like what data do you even have available? Because a lot of times these aren't publicly announced. If there's not a public company involved, like you might not even have a number for this. And so, for example, for Francisco Partners, they're not a public company. They're a private equity firm. And so they don't have to disclose very much information at all about the deals that they're doing. And then we've got to look at outliers. And so, for example, like if we look at this right here, we would see, hey, Google Wiz, like that might be an outlier. Like the multiple there is 32 times, whereas the multiple here is 3 times. And so there's like clearly like a huge spectrum here, like a 10 times differential, an entire order of magnitude difference in the multiples that we're looking at here. And so we've got to be careful. And then lastly, this is just this is just subject to interpretation. And so precedents usually are the upper valuation bound of what we're looking at. Okay, let's keep going. Last but not least, DCF, discounted cash flow analysis. This is what it's going to look like. This is what we're going to dig into in a little bit here. Now, fundamentally, key concepts here. This is the intrinsic valuation methodology. So we have the comparables and the precedents, which are comparable valuation methodologies. DCF is intrinsic. And so what we're trying to do here is we're saying, okay, what is the future cash flow of the business? We're going to discount it back and we're going to say that the business today is worth whatever the future business is going to generate in terms of cash, discounted back. And so that's going to require you to forecast out your free cash flow. It's going to create a forecast period. You're going to have to figure out at the end of that forecast business period, what is the business going to be worth way out in the future then? And then we've got growth assumptions. We've got a whack where we're discounting it back. We've got to consider what the assumptions of the terminal period are. And fundamentally, we've got to like make sure that we're understanding that a lot of this still is subjective. And so I hate to burst your bubble on the DCF, but it's not really an intrinsic valuation methodology. Like when you come down to it, at the end of your DCF, most of the time, the way we calculate terminal value is the multiples method. Now, the multiples method, for those of you who don't recall, is basically saying, okay, the valuation of the business at year 5 or year 6 or something like that when we sell is going to be equal to whatever multiple we assign to the business multiplied by like the EBITDA or something. And so that multiple is fundamentally informed by comps and precedents. And so there's a little bit of comparable valuation here that enters into the DCF. Now, theoretically, if you use the perpetuity growth rate method, that's not true. And the DCF truly is an intrinsic valuation methodology. But even then, when you're calculating the WACC, little bits of the market come in. You've got the betas, and you've got the interest rate from the Federal Reserve, and you've got the market risk premium. And so even a DCF is not entirely isolated from the economic and market conditions in which it exists. So without further ado, last pop quiz here before we jump into Excel. Which of these methods do you think is most assumption driven? One, comps, two, precedents, three, DCF, and then advanced for whatever one you don't think is correct. What are some of the critical assumptions that you're making? Okay, so let's talk through this. Most of you correct that in fact it is the DCF is usually considered to be the most assumption driven, but comps and precedents actually do have very, very, very large and very important assumptions. And the primary one that I didn't see in here is which comps and precedents you choose. Like fundamentally, as an investment banker or as an investor, like you can entirely change the valuation of the business just based off of which comps you choose. And so if you decide to nix one of them, you're like, ah, that's not a good comp. And you don't really explain why. You can change the multiple of the business like dramatically. And same thing with precedents. And then you've got to consider, are we using LTM multiples or NTM multiples? Are we using EBITDA multiples or revenue multiples or PE multiples? And are we going to adjust for, different accounting practices? Are we going to make sure that they're on an apples to apples basis? Or are we going to just keep them as they are? Are we going to like look at them on like different currencies? Are we going to calendarize them? How are we going to calendarize them? Like there's a lot of judgment that still goes into that. And then fundamentally, when we look at the comps and we have the mean and the median, do we use the mean? Do we use the median? Do we use the 75th percentile, the 25th percentile? Do we strike out a couple as outliers just because they're really high, or is that a good comp? And so there's a lot of judgment that does go into comps and precedents, even though, yes, the DCF is also highly assumption driven. So at this point, I just want to say I know we've been moving fast. I know we've been going quickly here. And I just want to offer for anyone who isn't already working with Wall Street Mastermind to feel free to like book a call with our team so we can talk through these concepts and help you out. This is not a sales pitch. I'm not going to push you to that. But if you feel like you need more support based off of what we learned so far, and it's only going to get tougher once we jump into the Excel, please do reach out. I'd love to help you a little bit more on the inside. With that, though, let's get ready for Excel. So this is the part you've all been waiting for. We're going to spend the next few hours together doing 5 things. We're going to start out by collecting the data that we need to build a financial model. Then we're going to build an income statement. We're going to build a cash flow statement. We're going to build a balance sheet. And then we're going to explore the valuation outputs in terms of comps, precedents, and DCF that we just walked through. So let's take a look at this. So this is going to be the financial model that we're going to be working on for the next few hours together. And so basically what I've done is I've laid out as much of the formatting as possible without the actual content in here. And so we've got the sources where I pulled in the income statement, balance sheet, whatever, for you. And then we're going to build them. And so we've got the income statement that's not filled out. We've got the cash flow statement. We've got the balance sheet that's not filled out. And then we've got some of the valuation methodologies, which are going to pull together. You'll get a football field, we'll get a P&L output, and then we've got some comps, precedents, and DCFs that are going to start to fill out once we actually have our own valuation, as well as some of the materials that we talked through in the slides. So we're going to spend probably, a few minutes talking through the sources. And we're going to spend most of our time today in these blue tabs here, which is the building the model on the income statement, the cash flow statement, and the balance sheet. And probably, if I had to guess, we'll spend the majority of the time here on the income statement because, like I said, that's the first among equals. It's probably the most important of the model's components. And then that's going to flow into the cash flow statement and the balance sheet before we get into some of these outputs over here. So that's the structure of the model. Tried to make it as clear as possible. So let's talk through this just a little bit here. So first off, we're mostly only going to change a lot of like once this is built in the future, you're only going to be adjusting some of the assumptions in yellow. Now we've got to build all the mechanics first, so that's not true yet. But once we've built the mechanics, you can update the model just by adjusting some of these assumptions and projections in yellow. Second thing that I'm just going to say for good modeling practice, make sure that you're using the right sort of colors in order to have a very solid model. And so blue is for hard codes, black is for formulas, green is for intersheet formulas. So if you're linking your income statement to your cash flow statement or something like that, And then sometimes you'll use like red for a really weird formula that you need to adjust, or purple or something like that for a link to FactSet or CapIQ, which if that doesn't mean anything to you, it doesn't matter. So let's talk through first how we collect the sources. So this is actually one of the most underratedly hard parts of financial modeling is getting the right data. Like a lot of people don't realize this, but it is very, very hard to like make sure that you've got like a clean income statement and a clean set of data to actually work with. And so there's a couple tools that we can talk through that make that a little bit easier. And I'm actually going to switch over to sharing my entire screen so that you can see what that looks like. Um, and so the first thing you're going to see here is that we've got like the income statement pulled in for you. So we've got the 2024 and the 2025, and you're going to see at the bottom here that we have a source. And so I'd recommend clicking on that source with me here. And as I reshare my screen, you'll see where this comes from. So you're going to see that I have basically the Excel on the left here, and then the BAM SEC on the right. And this is often the place where it's best to get your financial filings. Like when you're an investment banker, you'll either get them, you'll pull them from CapIQ or FactSet, or maybe Edgar, SEC Edgar, but more likely you're going to use a third-party tool like BAMSEC that pulls all of them, aggregates them, makes them very searchable, downloadable, and that sort of stuff. And so I'm showing you the actual nuts and bolts that real investment bankers use. And so instead of going and like copying and pasting and taking this data from the 10Q of Sentinel-1 or 10K of Sentinel-1, and like if you were to do this manually, you'd have to go, okay, 821 for 461 for the revenue, and then you type in the COGS of like 211 106 or something like that, and you can see I've like already made typos, the formatting's bad and stuff like that. Typically, you're just going to get something like this. You're going to select similar tables once you get a subscription, and then you're going to download all of it. Now, of course, that may require you to make an account. Your school may provide you an account or something like that. Worst comes to worst, what you can do is you can just like rip and replace, copy and paste the table, and that'll do a pretty good job getting the basics into Excel for you so you can build your financial model. Not bad. So you can see though that we've already done that for you on the income statement. But let's go back and like look at how we got to this income statement in the first place. And so the filings for this business are going to come by going to the company's page in BAMSEC or whatever other tool that you want to use and basically looking through the financials. Now, we've got a bunch of different types of financials. There's 10Ks, there's 10Qs, there's S8s, there's 4As, there's 8Ks, there's Def 14As, Def M 14As. Like there's tons of filings that companies produce. Now, realistically, you can probably get away with knowing four of them. The first one is the 10K, probably the most important. This is the annual report of the business. And so this is going to be a massive document. It's going to be like, 100 plus pages. You can see that this one is what, like 130 pages or something like that covers everything. It's got the business, the risk factors, the financials, the directors, the executive compensation, just like tons of information. Second one is the 10Q. This is the quarterly report, and I think of it like the 10K Lite. It's got almost as much information, but instead of being 100 plus pages, it's like 90. And it's got like some of the information, but not all of it. It doesn't have like the risk factors. It doesn't have the business description and stuff like that. And so if you're like trying to actually learn what Sentinel-1 does, which is the company that we're looking at today, you're going to actually want to go and like read through the 10K and like understand like what is the business? Like you've got this whole talk about cyber attacks and AI paradigms and singularity platforms and things like that that you can go and understand. That's the first two. The third one is the 8K. Now, the 8K is important because sometimes in the 8K, they produce non-GAAP reports. So what do I mean by that? Well, GAAP, generally accepted accounting principles, I believe it's a standard that's created by the FASB, the Financial Accounting Standards Board, that basically determines all the rules of accounting. And so the rules of accounting go and determine the 10K and the 10Q. Like these are legal documents that are published with the SEC, filed with the SEC, like they will get sued if these are wrong. But the 8K is a press release, basically, where they're doing things like they're announcing changes in the officer and compensation and stuff. And it's still like a very formal report, but sometimes they're willing to give you a little bit more like non-traditional commentary. And so we'll see if they have that here. But like, for example, for Sentinel-1, instead of just showing revenue, which is like a normal traditional GAAP metric, they're also showing ARR. And they're also saying the number of customers with ARR of 100K plus. And like that's a metric that's non-GAAP. It's not going to be something that you're going to find in the 10K or 10Q most of the time, but you will find it in the 8K. And that's very important because as investors, we care about these things. Like we care what the non-GAAP gross margin is. We care about what the non-GAAP operating margin is almost more in some ways than we care about all these GAAP financial statements. And they've also got like a little bit of information here about other components, and they do reconciliations where they say, okay, here's the GAAP COGS, here's the non-GAAP COGS. And most of the time, you're actually going to want to use the non-GAAP metrics. And so the 8K is deceptively important, even though you don't hear about it as much. The last thing that I'll say about why the 8K is so important is timing. So let's take a look at this again. I'm going to pop this open to my full screen so you can see the dates. So the 8K for their third fiscal quarter was released on December 4th of 2025. The 10K or the 10Q was also released on December 4th. That's uncommon. Most of the time, businesses have at least a couple of weeks of delay between when they release the 8K and when they release the 10Q and the 10K. And so there's sometimes when you're spreading comps as a banking analyst or a private equity associate or something like that, where you're going to need to go to the 10K, and then you're also going to need to go to the 8K because it will have more updated, more relevant information that you can get faster than is going to be released in the full 10Q and 10K. Um, Now, last but not least, the other thing that you're going to need to know is the S1. And we're not going to look at the S1 here because you only need to know it for companies that are IPOing. And so for a company that's recently going public, they produced a document called an S1 that basically lays out everything you need to know about a business. And the S1 is like a 10K on steroids. And so it's got like 200 plus pages. It's got like multiple years of financials. It's got tons of data, everything that someone would need to know to make an informed decision about whether they'd invest in the stock. And so in order from most detail to least, it goes S1 is the most detailed, then the 10K, then the 10Q, then the 8K. S1 is least frequent, then the 10K is annual, 10Q is quarterly, the 8K, they publish them very regularly, very quickly. And so you're trading off between which financials you use, between which ones are fast and accessible, and which ones are very thorough and deep. So I know this sounds like a tangent, but it's really important to make sure that you understand what financials you should be using and how to access them before you're actually able to build a model. So that gets us the income statement. And on the income statement here, you'll notice that we've only got 2 years of historicals. Now, a lot of the times when I'm building a financial model, I try and go back as far as possible. Like I want 5, 10 years of data or something, just so I can like see what the trends have over time. But at a minimum, you need 2 years. Why not 1 year? Well, because you don't know what the growth rate's going to be. And so because we have 2 years of historical data here, we're going to be able to calculate what the growth rate is between these 2 years, and we can use that as a data point to extrapolate in the future. And so we know that this business grew about 30% last year. And 2 years of data is also important because you can see how things change. So like, for example, let's say that we calculate the gross margin and we say, okay, for 2024, it's 29%. For 2025, it's 26%. So which is it going to be in the future? Is it going to be some average of those? It's going to be like 27, 28%. That's a great question and something that you need to think about, but you wouldn't even know to think it unless you had multiple years of financial data. So next up, of course, is the cash flow statement. So let's go back over to our 10K and take a look at where that came from. So if we were to look at this, let's see. So remember my hack where I said that cash and cash equivalents is the fastest way to get to the balance sheet. So usually what I do is I do a control F here, and you don't have to follow along for this part if you don't want. I do control F for cash and cash equivalents. That takes me to the balance sheet. And so then I know that the balance sheet, the cash flow statement, and the income statement are going to be right next to each other. And they've got a couple other statements that we don't talk as much about, like the statement of stockholders' equity and like the consolidated statement of comprehensive loss. Like you probably don't need to worry about those, but there are technically more than just the three main financial statements that you hear about in interviews. But most of you didn't know that. And so what you'll see here, we've got the balance sheet, and this has 2 years of data. We've got the consolidated statement of operations, which this is like code word for the income statement here. And so like you can see it's got like all the same line items. Like this is consolidated statement of operations equals P&L equals income statement. Cash flow statement is usually going to be somewhere to the bottom of these. And so we scroll past the statement of stockholders' equity and we've got the statement of cash flows. And so this here you can see is a beast. Like there's a ton of stuff in here. You've got like all these weird things at the bottom. You've got like all these cash equivalents. You've got all this restricted cash. You've got all these, supplemental disclosures and things like that. Like you don't need 90% of this, but you download it anyway, just so like you understand like what is the stuff you're working with, get it into the model, and then simplify it. And so basically, like I'm saying, the more data that you can ingest into your model, the more informed of assumptions you're going to be making. And so if you're asking, is 2 years sufficient? Like, not realistically. Like, I like to, again, I go back as far as they give me data. Like, some public companies, they'll give me data back into like the 80s or something. I think that's just super fun. It's not as relevant. Like, what they did in 1985 isn't that relevant, but it's fun to me as I'm building a model to like see, okay, like, what did the trends look like? What are the patterns of this business over time? And then I like to make sure that I'm just using the most relevant few years, which could be anywhere from 2 years to 5 years or something like that, to project the business from there. Okay, so that's the income statement. That's the cash flow statement. Also going to get the balance sheet from up here. And you're going to see that the balance sheet on paper here, again, has like 20 different lines, and there's a ton more detail behind each of these things. And so just to give you a taste for how simplified even this balance sheet is, let's go see if they have like a breakdown of the cash and cash equivalents here. They might not, but they might. So this is an experiment that we'll run together. So let's take a look at this right here. So they've got 186,000. So that's $186 million of cash and cash equivalents, basically. And so let's go see if they have any more data on this. So let's see if we control F this number here in the filings right here. Um, that's going to take us to another table down here where they give us a breakdown of where all this cash comes from. So they've got cash, they've got money market funds, they've got US Treasury securities, they've got commercial paper, and that gets us to the number that we saw on the balance sheet up there. And so behind almost every single line item here, there's usually a note in the financial that explains what that number is in greater detail. And that's why this is 130 freaking pages, is because every single one of these lines has more lines behind it. And the only reason I'm telling you that as a financial modeler is because you need to understand what all of the detail is available to you so that when you're making modeling decisions, you're able to make the smart ones. So let's go back over to our model now. You've got the statements. Hopefully that makes sense in terms of how to actually get the data. And I would highly encourage you, after you do this bootcamp today, to go home and make sure that you can calculate this by pulling data on your favorite company and starting to build a model like the one that we're going to build now. And you can use this template if you'd like. So let's dig in. Let's actually start building the model here. And by the way, I'm just going to call out some of the keyboard shortcuts I'm using to get around as I'm doing it. So in order to get to the next tab, I do Control Page Down. And for Mac, I think it's like Command Option right arrow or something like that. So for income statement, let's talk through what we've got here. First off, we've got these two headers here. We've got fiscal year and we've got calendar year. And we've got historical periods and we've got projected periods for each of these. And so you can see that we've got 2 years of historicals, and then we've got 1, 2, 3, 4, 5, 6, 7 years of projected. Now, that's not super common. Most of the time you do a 5-year projection, but for our purposes here today, we're going to build a little bit longer of a DCF, and so I decided to give us 7 years of projections. And so that's kind of what we're looking at here. Ignore the calendar year stuff for a second. Let's just stay focused on the fiscal year. And then we'll come back and we'll talk about the difference between fiscal year and calendar year. We'll talk about some of the overlap percentages and things like that. That's a nuance that we'll get to when we get there. But let's look at the actual categories along the left here. So we start out with revenue. You take out the COGS, you get to gross profit. We talked about this. You've got sales and marketing, R&D, G&A, restructuring, operating expenses, operating income, D&A, get to EBITDA. Subtract out a couple things, we'll get to net income, and then subtract out a couple other things, and we'll get to like this GAAP cash EBITDA metric, which we've got. And this is, again, this is every model is unique to every different type of investor and every different type of company. And so when you go to your internship or you go to your job or something like that, and you're like, what's GAAP cash EBITDA? Like they're probably going to have a different definition than what I'm showing you today. And so don't go say, hey, Max is an idiot. He doesn't know what GAAP cash EBITDA is. Say, hey, everyone has different definitions of some of these terms. Let's think through analytically what would be useful. But let's start to fill this out. So the first thing that we want to do is we want to populate the historical data here. And so in order to do that, what I'm going to do is I'm actually going to pull open two tabs of Excel side by side so I can copy paste back and forth quickly between them. This is going to be a really, really useful modeling skill So I want you to follow along closely if you can. So the first thing I'm going to do is I'm going to do Alt W N. And so let me just walk you through what I just did there. I'm going to undo what I just did. So the Alt takes you up to the keyboard ribbon. And for those of you who are using accelerator keys, that should work on Mac, or Parallels, that should work. Otherwise, just go over to the View tab W with me and then click on this N right here, which is New Window. This is one of the most important modeling shortcuts you'll ever use, is to have multiple windows. And so what you'll see that this does, you see how there's a 2 up here? That means that it's the second screen of this exact same model. And so I'm going to use Windows key right arrow to like show you that in fact I've got two models open side by side right now. And so you can see I've got on one side one model, on the other side another model. But you can also see that like if I change this right here, it's going to show up in the other one as well. I guess that didn't work. So if like, I delete this right here, you can see it deletes in the other one. So it's the same model. And so this is going to make it super easy to go back and forth and like copy paste stuff. And so let's go over to the actual like backup financials here. And I'm going to start copying over some of these things. Now, because the frame doesn't work, I'm going to decrease the width of this column so I can see what the label is and the numbers. And so I'm going to do Alt-HOW to reduce the width of the column. Doesn't matter if you follow along super closely on that. I'm just going to reduce that to, let's call it 90. Okay, so now I can see the revenue. I can see this. I've got this here. And so what I'm going to do is I'm going to start copying over the key pieces of information to my P&L over on the left here. And so I'm going to take the revenue from the backup file. I'm going to hit Control C. I'm going to hit Alt Tab because Alt Tab enables you to sort of like toggle between the windows. And then I'm going to hit Control Alt V. And that's going to open up this paste special menu. Now, if you're already an Excel whiz, go ahead and like do this and link it over. But if you're not, pay attention to this. So the paste special menu is one of the most important Excel skills that we're going to use in our entire time together. And so basically enables you to paste just the formulas from whatever you copied, just the values from whatever you copied, just the formats. And you can see these little underlines, the arrows there or like these underlines basically enable you to do like the formula or to like hit a number or like a letter like F and it will just paste the formulas or V and it will just paste that. Now there's a really confusing thing here, which is this one down at the bottom that is super, super critical, which is paste link. And so if I hit L, it's going to trigger that. And it's basically going to create a link here. I'm hitting F2 escape to like toggle between this that links back to the other statement. And so you can see here that this links back there. And if I hit control back bracket, it will take me there. And I'm going to hit F enter or F5 enter to get back. So I'm just going to do that one more time. So going back over to this tab over here, which is the backup tab, I'm going to hit Control C to copy. I'm going to hit Alt Tab to get over to this other one, or you can just click there if you need to. I'm going to select the range that I'm trying to replace. I'll delete it for now just so you can see it again. And I'm going to hit Control Alt V. For Mac, that's Command Option V. For Windows, Control Alt V. For Mac, Command Option V. And so I'm going to take this, I'm going to copy it, and then I'm going to do Control Alt V, and then I'm going to hit the letter L. L is in Lima, and that's going to paste a link to the other thing. So get this one down because we're going to be doing this a lot. And, there's other ways to do it. Like if you truly did not follow that, what you could also do is you could just like delete this. You could hit equals, and then you could go over here. You could click on this and you could say 621, hit enter, and then it's going to give you the same thing. So if you're following along, great. If you're not following along, pay attention. That's going to be a really important one. I'm going to explain it a couple more times as we go. And that's going to get us the revenue. So we've got the revenue here in thousands. And then we're going to take our growth rate. We're going to take this. We're going to take the 2025 divided by 2024, subtract 1, and that's going to give us the growth. And luckily for you, I already formatted it nicely for you. It's a nice percentage. You don't have to worry about it. So we've got the revenue. Let's do the same thing for COGS. So over here, we're actually going to back into COGS. So we could do this one of two ways. We could take the COGS and then calculate the gross profit, or we could calculate the gross profit and then back into COGS. And so what I'm going to do is I'm going to take the gross profit here. And again, I'm going to hit Control C. I'm going to do Alt Tab and then Control Alt V or Command Option V on Mac. Hit L to do the link. And then that's going to bring the gross profit over here. Then I
Where
can
the
calculate
fuck did you
the
get that
profit.
fuck ass number from?
Excuse me, can you please use fewer expletives, please, and maybe ask the question again.
Wait, I'm so sorry. That was totally not meant for you. Someone walked into my room.
Okay, no worries. Please stay on mute if you have any questions. I was like, sorry, I didn't mean to piss you off here.
No,
But anyways,
I completely apologize. That was
no, totally
someone
fine.
I didn't even know people had access to this space, and I don't know how I got on off mute anyway.
All good, all good. Thank you so much. So let's go into COGS here. So the COGS is basically going to be gross profit minus revenue. And so basically what we're going to see here is that that calculation should work where basically it's the 440 minus the 620. And so that's going to be negative 180,000 on the COGS. And so then we can take this and we can just copy that right. And so I did Control R to bring that to the right. Now you'll see that that actually messed up this border here. So I'm going to zoom in a little bit so you can see that better. Before I did that, or well, actually, I'm going to hit Control Z so you can see before and after. So before I did this, you see how there was this border right here. There's this nice little dotted border between the historical and projected period. And so between 2025 and 2026, we've got these dotted borders here. And so when I do Control R to copy over the formula, it messes up that border. And so this is another situation where we need to paste the formula, not just do Control R. And so I'm going to do Control Alt V and then formulas, and that's going to get us there. And so you can see how the border's not messed up when I do that. Um, and then basically, this is going to be COGS is as you said, the gross profit minus the revenue to get us a negative number. You could also do it the other way around where you do revenue minus gross profit to get us a positive number. But in most of my P&Ls, I like to present expenses as negative numbers and everything else as positive numbers. So that's a stylistic preference. Just make sure it's consistent and make sure that the math works either way. Here, I'm going to do the COGS as negative numbers. Now, then we can calculate the COGS as a percentage of sales. So I'm going to take the COGS, I'm going to divide by revenue, and that's going to tell us that the COGS as a percentage of sales is about 30%. Don't worry too much if you mess up the formula just by copying it over. Like you can do Control C and Control V, or you can do Control R, like I was saying. But I'm going to be a little bit more particular on the formatting, and I'm going to do Control Alt V, and I'm going to paste the formula in order to make sure that we don't mess up this nice little dotted line that I've put in on the historical versus projected period. So then we're going to calculate our gross margin. So we're going to take our gross profit, divide by the revenue, and that's going to get us our gross margin. And so we can see that this business is actually pretty healthy. It's got mid 70s gross margin, 71 to 74% or something like that. That's great. It's pretty healthy for a software business. With software businesses, sometimes we even like to see up to 80% gross margins. Then we're going to populate the expenses. And so at this point, it's going to start to be a little bit more traditional, a little bit more easy to follow along. There's really just a kind of a rinse and repeat pattern that you get into with each of these things. Um, so gross profit, we've got that calculated, and then we're going to calculate sales and marketing. And so the sales and marketing expense here is this part right here. And so we're going to take those two things and we're going to copy those over again. And so this is going to be, again, the Control Alt V and then hit paste link. And again, if you don't want to do that, like you can do this in a couple other ways. Like you can actually just copy and paste the values if you want. Like you could do Control Alt V V, and then you just want to make sure that this is hard coded blue because it's a value. And there's a specific color of blue that I would need to like get the exact formula code, but I'm not going to do that right now. So this is going to be sales and marketing expense. The other way to do this, just as a reminder, is you can literally just hit equals in this cell and then link it back over to the sales and marketing expense. And then I'm going to do the same thing for the R&D and the G&A. And so the R&D, I'm going to copy this over, going to paste the link. G&A, I'm going to copy this over, and then I'm going to paste the link. And then, um, and then we've got this restructuring component. So let's stop there for a second. So we've got the sales and marketing, the R&D, and the G&A. This is like the classic components of SG&A, like the most major buckets of like the operating expenses, OpEx. And so then we've also got a couple of other random things like restructuring here. Now, restructuring expense, this is basically saying like what is like the cost of like changing the structure of the business. And so this is not an operating expense because it's like a kind of a one-time random thing where you're like selling a division, you're buying a division, like there's something like that that's going on that's impacting the operations of the business, but it's not really related to the operations. And so sometimes you're going to get weird stuff like this that's pretty small. And if it's much bigger than that, you're going to need to pay attention to it and try and figure it out. Now, given that it's just about $7 million right here, this restructuring expense, I'm just going to link it up. I'm not going to ask too many questions. That was in 2024, not 2025. We frankly don't have time to go down every rabbit hole and figure out what's going on here. Okay, so we've got our operating expenses. We've got sales and marketing, we've got R&D, we've got G&A, we've got restructuring. These are the operating expenses, and hopefully you've been able to either follow along up to this point, or if we're moving too fast, feel free to just watch along. And so then what we're going to do next is we're going to take the operating expenses, we're going to calculate the sum of these different things. So we're going to take the sales and marketing expense plus the R&D plus the G&A plus the restructuring. And so that's just a simple sum formula. Now note that I'm not doing this. I'm not going sum of all of these things and just like hitting that. Now, why not? Because we're about to add in the percentages. And so this is a rookie modeling mistake that I see all the time with analysts who are like trying to do a good job with this, where they're basically they do a sum here, and they basically try and capture some of these pieces, and they accidentally add in the percentages of sales of R&D and G&A. And so here, what I would say is you want to do a specific addition formula where you say equal A plus B plus C plus D. And so what we're going to do here is we're going to next go and calculate the percentages of sales on each of these things. And so I'm going to say equals the sales and marketing expense divided by revenue. Revenue, sales, same thing. Now, the next thing I'm going to do is I'm going to anchor my formula on revenue. And so what I mean by that is I'm going to hit F4 right now. And you see how it adds these dollar signs? That means that it's anchored. And so I'm going to hit F4 twice until there's no dollar sign and then dollar sign. And basically that means that the row 17, is anchored and the column is not anchored. And so that's going to make it easier because then when I copy this over and then copy this down, it's going to automatically get the formula right. So look at that. It took the R&D divided by the revenue. Now, let's say that instead I hadn't anchored this cell right here. I just did C26 divided by C17. Then when I copy this down, it's going to totally mess it up. You see how it sort of like is taking out as a percentage of COGS now, which is just totally nonsensical. And so I'm going to hit Control Z on that. And now you'll see that it in fact is anchored properly on these cells. Okay, so hopefully everyone's caught up on this. Let's copy these formulas down that are a little bit more locked to the G&A, the restructuring, and the operating expenses. And so what you can see here is a funny thing where in fact our operating expenses are 132% of our sales. 132%. And so that means that this business is like dramatically unprofitable. And we've also got to make sure that we fix this thing here because it's off by a little bit because it was including the sales. So the last thing I'm going to do really quickly here is I'm going to make sure that these are negative. So remember how the COGS we were presenting as a negative here? If I'm going to present the COGS as negative, I have to present each of these other things as negative. Otherwise, the formulas aren't going to quite work. And so I'm going to take the sales and marketing expense and I'm just going to quickly add a negative at the beginning. So I'm going to hit F2, Control up arrow to get to the top of the cell, right arrow to get past the equals, and do that. And so then I'm going to do that again. And then I did a little bit of a fancy trick where I did Control Enter on those ones. We don't need to talk about that right now. But if you're advanced, you can try and follow along. But basically, what I'm doing is I'm just turning these into negatives so we can have now negative operating expenses. If yours are positive and everything else is positive, that's fine. But if you want to follow along exactly, make sure that each of the operating expenses and COGS are negative. Okay, so we've got a business. Let's take a look at this. So the business is generating $600 million of revenue a year, and it's generating $820 million of expenses. So it's unprofitable. Let's go calculate how unprofitable with operating income. And so this fundamentally is going to be calculated either as your revenue minus your COGS, minus your S&M, minus your R&D, minus your G&A, minus blah, 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 blah. Or we can just go take a little bit of a shortcut and take gross profit minus your OPEX. And since our OPEX is negative, we'll just add them. And you'll just check, does this number look right? Well, if we have $400 million of gross profit and we generate $800 million of expenses, then yeah, you're going to have about negative $400 million of operating income. So We'll take that over, we'll calculate that. Now for this next line here, you see that it says percent margin. Now, percent margin fundamentally is the same thing as percentage of sales, but when we sometimes we calculate expenses and we call it percentage of sales, and we calculate profitability metrics like operating income and EBITDA and call it percent margin. It's just finance custom. There's not like a great reason why, but all you need to do is just copy down the same formula. And if you anchored it correctly, then it should work. And so what we're saying here is that we're about negative 61% operating margin. So next up, we've got D&A. So depreciation and amortization. This is a more complicated part of the P&L because it's not a cash expense. It's related to accrual and to the property, plant, and equipment and things like that. And so we've got to make sure that we're linking this over correctly. So let's go back over to our original income statement and link over the D&A expense. Well, that was a little bit of a misleading thing because if you look at it, there's no D&A on the income statement. And so, ironically, when we're building our income statement over here, we're going to actually have to pull D&A from the cash flow statement. And so let's go back over to the cash flow statement on the source side of things. And so the way that I'm going to navigate between these tabs again is control page down and control page up. So I'm going to go control page down to get to the cash flow statement. And you're going to see that we've got this depreciation and amortization here. And so the depreciation and amortization, the 39 million and the 43 million, I'm going to then copy over, Control C, Alt Tab to get to the other screen, and then Control Alt V as always to link this over here. And so we've got our D&A, we've got our D&A for 39 million, 42 million, and then again for percentage of sales, we can just copy that formula down one more time. So we've got our operating income, our EBIT, aka EBIT, like this is basically the same thing as EBIT. And then we've got our D&A. And so then our EBITDA is going to be the sum of those two things. So we've got $380 million of expenses, but part of those are non-cash expenses, aka D&A. And so our cash, like our GAAP EBITDA, is going to be $340 million. And so if we copy over that formula, you're going to see that it's actually improving in profitability. Like we went from a business that was losing $340 million of EBITDA last year to a business that's only losing 290. And so the margin improves dramatically because not only is the profitability going up, but also the revenue is going up dramatically. And so as a percentage, a few $100 million of losses feels a little smaller. So let's just make sure everyone's with me so far. I'm going to scroll up a little bit. So we've got our revenue. We linked it over. We calculated the growth by taking period 2 divided by period 1 minus 1. Then we got our COGS. We calculated this by basically taking the difference between the gross profit and the revenue and calculated each of these things as a percentage of sales. Then we calculated our gross margin or gross profit. We pulled it over from the income statement. Realistically, we could have done it either way. Like we could have pulled in the COGS and then calculated the gross profit, or we could calculate the gross profit, pull in the COGS, like either way. And then calculated the margin based off of that. Then we began pulling in the expenses. So we did sales and marketing, R&D, G&A, restructuring, and summed up the total operating expenses. And for each of these, not super important, but we calculated these as a percentage of sales. That got us to our operating expenses and ultimately to our EBIT. Now, one thing to note here is that D&A we're actually adding back. And so unlike these other expenses, which are negative, we're adding back D&A to get to EBITDA because it's earnings before interest, taxes, and depreciation and amortization. And so that's going to be a positive thing, whereas the others are negative. And so whatever you do to get there, like just make sure that your EBITDA is higher than your EBIT. It's always going to be at least equal, but certainly usually higher. And so we're going from negative 380 million to negative 340 million. Okay. Hopefully that makes sense. And hopefully you're all with me so far. So the last little bit that we're going to do is we're going to get down to net income, and then we're going to get down to GAAP cash EBITDA, which is kind of a made-up metric that we're using today for the sake of this model to like kind of understand capital expenditures and capitalized software. And I apologize, David. I'm going to keep moving just to make sure we can get through this. I'll let everyone catch up at the end of this, and I can take some questions while people are catching up. So next up, is net interest income and expense. So this is going to come from the income statement here, where let's look down and see where did this come from. Well, we've got interest income, we've got expense. And so this is going to be the sum of these three like random items here. So we've got interest income, which is income that we're earning from the cash that we have on the balance sheet and like the short-term investments and your investment in Apple stock, whatever the heck it is. We've got our expenses, which is the interest expense that we're paying on the debt that we've accumulated. And then we've got our other income net, which is just random stuff like, your fees to your tax auditor or something like that. Like that might be going in G&A or like, an SEC fine or like you sold something and got a gain. Like who knows? Like some of these things are just going to go into this other income and expense bucket. And we lump all of that together into this line right here. So pay attention to this formula here. I'm just going to do a sum formula. I'm going to say equals the sum of the interest income, the interest expense, and the other income. So that's going to get us our net interest income. And so you're actually going to know it's positive. Like we are actually generating income from our interest because we don't have any debt and we have a lot of cash. We'll come back to that when we talk about capital structure for Sentinel-1, but this generates interest income. So I'm going to copy that over, just paste the formula. You're going to see that we're going to have positive net interest income in both periods. And then that's going to get us a pre-tax income that's a little bit higher. So with pre-tax income, the formula here is basically EBT. And so I'm just going to put that here. So operating income is EBIT, earnings before interest and taxes. Pre-tax income, on the other hand of things, is earnings before taxes. So it's like basically just after you've accounted for everything but the taxes, you've got EBT. And so in this case, what that's going to be is your EBIT plus your interest income. And so that means that our pre-tax income is going to be something like negative 330 million. And then go over here, great, negative 280 million. So it's actually not too different than our EBITDA. And the reason for that, it's just coincidental, but the DNA is approximately similar to the net interest income and expense, within a few million. Okay. Last but not least, before we get to net income, is taxes. And so the taxes here is basically going to be this thing right here. And so the taxes are actually going to just be relatively small. They're a teensy little number. And then since these are paid out, this is going to be a negative number. So we've got negative 6 million, negative 7 million. And so the tax rate here is going to not really make sense because we're basically saying that we're paying like 2% of our loss in terms of taxes. And so it's like this is kind of a useless metric for a company like this, but like if it's a profitable business with hundreds of millions of dollars in income and you're paying a lot of taxes, then like that's going to make sense. But like 1.8% when they're both negative numbers, like it doesn't really compute at the moment. So last but not least here, we can calculate the net income. So all you do here is you take your earnings before taxes, you subtract out your taxes, that gets you your net income. And then we can calculate the percentage of sales. Now, if you're falling behind, don't bother calculating like the percentage of sales on these things. Like that's just a waste of time. Like, it's interesting, but it's not necessary. For those of you who are on schedule with us, like, feel free to keep doing that, but like don't feel bad if you lose out on some of these like percentage of sales or percentage tax rate. Like those aren't going to drive anything. That's just for our investors and like our interest as investment bankers and investors. Okay. So before we get to the CapEx and the capitalized software, I'm just going to recap what we've done so far. So again, we calculated the revenue, calculated the growth. We added in all the expenses, and that got us to EBIT. We added back the DNA because it's a positive add back to get to EBITDA. And then we took out interest expenses, and that got us to this net piece. And then last but not least, we got down to the taxes and the net income, calculated that as a percentage of margin. So we got to our net income. The last couple pieces that we need to do here are the CapEx and the capitalized software. So for CapEx and capitalized software, how are we going to calculate these? Well, again, these aren't going to come from the income statement. Like if we go over to the income statement, we try and find CapEx and capitalized software, like it's just not going to be on here. And so this is another thing where we're going to need to pull from the cash flow statement to build our income statement. And so if we do that here, we're going to find capital expenditures on the cash flow statement right here as purchases of property, plant, and equipment. aka capital expenditures. And so these are basically the same thing, but it's going to be called purchases of property, plant, and equipment. And so I'm going to take this and I'm going to basically say, okay, capital expenditures is going to equal -1 million and -2 million. And so this goes back, remember earlier when I was saying that software companies don't have a lot of CapEx? Well, that's true here. Like in general, not a lot of capital expenditures because like realistically, all that they're buying for capital expenditures is like some office furniture or some laptops and things like that that are relatively cheap. Capitalized software, though, is a much bigger deal. And so that's going to be this line item right here, capitalization of internal use software. Accidentally opened that, you don't need that. Capitalization of internal use software. And so capitalization of internal use software, basically what this means is this is software that SentinelOne has developed for its internal employees' use. And it's generated a lot of like really valuable internal software. But it's not an expense because it's going to be used for years at a time. And so instead of expensing the software, they capitalize it. They put it on the balance sheet over time. This is a very important concept for those of you who are interested in tech finance, tech investment banking, tech private equity, tech investing, growth equity, venture capital, something like that, is knowing what capitalized software is. So this would be a good time if you're not following along, you don't know what capitalized software is, go write that down as a concept to revisit. So let's take this here and we're going to link over the capitalized software. And so we've got the capitalized software. We're going to calculate that as a percentage of sales. And we're going to see that they actually invest a substantial portion of their profits on developing this software. And we're going to penalize them for that. Like we're going to calculate this GAAP cash EBITDA in a way that accounts for that because that's a real expense that they're generating on an ongoing basis to like build stuff internally. And so we're going to take this GAAP cash EBITDA is equal to the GAAP net income plus the CapEx plus the capitalized software. And that's going to copy over. I'm going to just paste the formula so I don't mess up the border. And then I'm going to copy over the margin formula one more time. Okay, so hopefully at this point, you have been able to follow along more or less, and you have kind of a similar historical P&L. Now, we don't have a ton of time for questions because we need to project the P&L and move on to the other statements. But if anyone is falling dramatically behind and has a simple question that we can answer to help you get caught up, I'd love to stop for just a couple minutes and answer anything that's coming up for people.
I
Yeah,
had a question.
yeah, I'm going to show the pre-tax income formula, but ask a question.
How did you get net interest income divided by expense?
So net interest income slash expense. It's not divided by, it's just like saying,
Oh,
hey,
okay.
income
Oh,
is a
okay.
positive number, expense is a negative number.
Mhm.
Yeah. So that's the pre-tax income formula, Sharif, and then Grayson, DNA and GAAP EBITDA. So DNA came from over in the cash flow statement here. So you're going to see on my right screen that we've got the DNA of 39 million and 43 million. And then the GAAP EBITDA is just going to be the sum of EBIT plus DNA. And so one little hack for most of you, anytime I'm summing up something, is basically just whatever is above it. And so like you should be building your models so that like you kind of understand that GAAP EBITDA is just going to be like operating income plus DNA. And then like GAAP net income is just going to be like whatever the heck is in between all this stuff summed up together. And then GAAP cash EBITDA is going to be whatever is between all this summed up together. Um, and then the tax rate is basically the taxes divided by the pre-tax income. It's pretty intuitive if you think about it. Like, what's your tax rate? Well, if you generate $100,000 of income at your job and then you got $30,000 of taxes, then that's going to be a 30% tax rate. And then the taxes came from the income statement over here. And so you just remember, look for it right here, which is provision for income taxes is what it's called. So that's where we got the 6 million and the 7 million here. And then in terms of calculating interest income over, this is the sum of the interest income, the interest expense, and other income slash expense. So I'll pause for one more second. Hopefully that answers most of the questions. I think we covered a lot of the formulas. Okay, great. So if you're doing well, stay caught up. If you're bored, build ahead, project out the income statement yourself. And if you're falling behind, you can make a judgment call whether you want to just watch and see how we're doing it from here, or you can try and follow along behind and build as much as you can and learn as much as possible. So whatever you do though, like don't just like get distraught and hop off. Like there's still a lot to learn just by watching and taking notes and things like that. So we built the historicals for 2024 and 2025. Now I want to just call out that we've got to project them now. And so that's what we're going to turn to next here, is we're going to figure out for these next 7 years, how are we going to take the historical data that we've built and turn it into something valuable? And so let's look first at revenue. So as we can see here, the business grew from 600 million to 800 million. That's a 30% growth rate. That's pretty good. Now, down here at the bottom, we've built out an assumptions table where we're basically going to use this to like build out our assumptions for what's going to happen next in the future. And so you can see that we've got the revenue growth, for example, and we've got no data for 2024, but we do have data for 2025. So the 0% is like kind of fake. That's not like an actual number. We should probably just delete that. But we do have 2025, and and then basically we've got to figure out what we want to do from here. And so we've got the 32% historically. Now, what are we going to do for 2026 through 2032? Well, there's a bunch of different ways that we could take this. The simplest would be just to hold it flat. And so like, let's say that we did that. Let's say that we basically said that income is just going to be the same as it was in whatever historical period, and that's just going to continue onward forever. Like, great. That's going to make things super simple and super easy. Now, is that realistic? Well, probably not. The reason it's probably not realistic is because basically, um, it's like, you've got this 32% and like that's probably not going to just continue forever. Like we're probably going to at some point face declining growth rates. Because if it continues to grow at 30% on a percentage basis, on a dollar basis, like eventually that's going to become larger than like Microsoft. That's going to become larger than the US economy. That's going to become larger than global GDP if it continues to grow at 30% and everything else is growing at like 3 to 5%. And so we probably can't have it grow at 32% consistently. So I'm going to pop open my screen a little bit wider, and we're going to use this like step ups section here, where basically what we're going to say is I'm going to have the growth rate decrease by 2.5% per year. Now I'm just going to copy this formula over, and then we're going to sort of like make up a growth rate that's basically the 32% minus 2.5% per year. And so that's going to get us kind of a nice curve that goes from 30% down to like 15%. And so that's going to be a pretty good way to project out the revenue. So let's just stay down here for a second and then we'll hook it up at the top. So we've got our revenue and we're saying that it goes from 30% down to 15%. Now, what are we going to do with our gross margin? Well, as you can see, historically, the gross margin has increased. We went from 71% to 74%. That's pretty good. And earlier, as you know, I was saying that the top SaaS companies, like the top software companies, they can often actually increase up to like 80, 85, sometimes even 90% in terms of gross margin. And so what I'm going to do here is I'm going to like create a similar step up thing where I'm going to say that basically the gross margin is going to increase by 0.5% per year. Make sure you don't do 50% like I just did, but 0.5% like that. And so then we're going to say, okay, so let's say that they slow down the growth rate. So historically they grew by like 3% gross margin per year, but let's say that they only grow by half a percentage per year. So they're going to go to 74.8, they're going to go to 75, 76, 77, 78, that sort of stuff. And so we're going to get close to 80% gross margin by the end. That's pretty good. Then for sales and marketing, what we're going to do next is we're basically going to assume a step up that's pretty substantial because if you look at this, they're currently spending 60% of their sales and marketing as a percentage of sales. And like we calculated this for you because it's like you already calculated up here. I just like brought it down. But that's not sustainable. Like no business is going to be super profitable if you're spending 60% of your sales or your revenue attracting new customers. And so the reason that they're doing this is because they want to grow as fast as possible and things like that. And there's a lot of pressure from investors to grow, but it's not very financially responsible. And so I'm going to assume that over time, Sentinel-1 is going to stop investing so much money in sales and marketing expense. And so let's assume that there's a 5% step up per year. And basically, this is going to go something like this. It's going to go from 54% down to like, 25%. Like that's, not ridiculous, but like if we're targeting about 25%, like let's just call that, somewhere in the 27%, like that's going to be about right for the ending period. Now, realistically, you don't need to like use the step up function if you want. Like what matters is whatever cells are in this section right here. And so if you wanted to, you could just type in -54, -50, -44, like whatever the case may be. Like just put in whatever assumptions you think make sense for the percentage of sales over time. At the end of the day, this is a thinking exercise here, building this financial model of saying, what do I think is going to happen with sales and marketing expense? So let's do the same thing with R&D. And so here you can see that the R&D is decreasing as a percentage of revenue as well. And 30% is also really high. So that means that they're investing a lot in their products. They're building a lot of new cybersecurity tools. That's great. Their customers probably love it. Their investors probably don't. They're like, damn, that's pretty expensive. And so same here, we're going to do a bit of a step up where we're basically going to increase this by, call it a couple percent per year. And so let's say that in year one, let's like, to some extent, this is just a judgment call. Let's say that we're going to increase this by about 3.5% the margin for the first few years. And then eventually, that's going to slow down. It's going to be like sort of an asymptotic curve where we're going to say that they're going to continue to improve the R&D margin, but like there's only so much you can do without like totally cannibalizing your future growth because you're not investing in your new products. And so if we look at this, this basically takes us from about, 30% R&D margins down to like 16 or 15%. And that's not going to be like a set in stone amount, but that's kind of a judgment call that you build over time. And so a lot of times students come to me and they say like, okay, like how do I know how fast to like decrease the R&D as a percentage of sales or the sales and marketing as a percentage of sales or how fast should the revenue grow? And a lot of that comes from intuition, built by seeing a lot of companies over time. And so the more companies that you look at, the more you're going to be able to triangulate what the growth rate should be and what the gross margin should be. And a lot of that actually comes from comps. And so let's take a second. I'm just going to take us for a second over to the comps tab. And so while people are catching up on some of these components here, let's go take a look at the comps tab for a second. By looking at the comps tab, we can see how fast their peers are growing. And we can see, okay, so it's somewhere in between like about the 10 to 20% range. And so we know that that's probably pretty reasonable. And we can see what the EBITDA margin looks like, and it's somewhere in like 20, 30% range. And then we can go and we could build a comps file that has their R&D expense and the SG&A expense and every other thing for each of these businesses to get some benchmarks of what this should look like. And so for now, you're just gonna have to trust me that I kind of have good intuition on like what these percentages should be. But when you're doing this yourself, if you don't have that intuition, you want to go look at what the comps are doing to make sure that you understand what these curves should look like. Okay, so next up, we've got G&A. And so the G&A here, let's just say that that's going to steadily increase in terms of margin over time. They've got this massive increase where they went from 32% to 22%. And then we're just going to say that over time, that's going to come down somewhere into the mid-teens. Now, last but not least, we've got this restructuring expense. And so as you can see, that was a small percentage in 2024. In 2025, it was zero. And so I'm actually just going to say zero going forward. And so I'm going to say that there's no restructuring expense. I'm just going to put this as, and I'm just not even going to fill this out. Like I'm just going to leave that empty. And so for the step ups, I'm only going to use that for this first section down here. And then for the rest of this down here, I'm just going to kind of going to do this in a different manner. So for DNA, there's a bunch of different ways that we could take this, but as the business grows, I'm just going to say that this stabilizes at around 3%. And so I'm just making a hard code there. I'm going to type that in, and that hard code is 3%, as you can see. That's why it's blue. The net interest income as a percentage of sales, it's 7.5, then it went to 6. And so I'm just going to say that like, subtract another percentage or two or something like that. Let's just call it stabilizing at 3.5%. Now, realistically, it could be 4%, it could be 3%, it could be 6%, like who knows exactly, but I'm just going to call it about 3.5%. Then for the tax rate. Now, the tax rate here historically was totally wonky. But does anyone know what the US corporate tax rate is right now? It's actually currently 21%. And so we're going to say that 21% is a pretty good bet for the current US corporate tax rate. And so we're going to say going forward, even though they've had like a weird tax situation historically, going forward, it's going to be in the low 20s. Now, CapEx is a percentage of sales. You can see that's been pretty low. And so I'm just going to keep it pretty low. I'm just going to call it negative 0.5% or something like that. It's kind of inconsequential, not a big deal for the business. And then I'm just going to copy that down. Since these are formulas, it's not going to be hard codes. And then last but not least, I'm going to hold the capitalized software at negative 2.5% of sales. And you can see that Excel just like auto-filled that for me. And so the bottom half was a little simpler here, where we basically said we're going to hold a lot of these flat because they're not changing quite as dramatically and they're not as important. Um, and so we've got 3%, 3.5%, 21%, negative 0.5%, and negative 2.5. And so this is, I'm just going to do a quick call out on formatting for colors right now. And so what we're looking at here, like the hard codes here are blue. And so anything that we like typed in a number is going to be blue. And the way that we get that blue, again, remember, is on the cover, we had some of like the specific colors. And so you can go and you can copy the hex code, or you can calculate the, or copy like the RGB code, and that's going to get you basically what this is. And so I won't go into too much detail about how to find that, but like make sure that you're doing a good job like distinguishing between what's black, what's blue, and what's this green color and getting those to look nice. Otherwise, your boss is going to be like, your model looks ugly. And so on a lot of these here, we're making a bunch of simplifying assumptions. And for a quick model, this is probably going to be good. For a modeling test in a private equity interview, you're probably going to be fine with this. But once you're working on the desk as like an actual analyst, a lot of these assumptions are going to need to be a little bit more nuanced. And so instead of just like putting your finger to the wind and saying, revenue growth is going to decrease by 2.5% per year, you're going to need to break down the drivers of revenue. You're going to need to understand like why. What does that look like? You might need to build a SaaS waterfall. Same thing with gross margin and all these expenses. Like you might even go so far as to calculate out the headcount expense for every single employee in the business and say, okay, if we hire someone here and we fire someone here, we give them a 5% raise, we give them a bonus, we decrease salaries, like what is going to actually happen to each of these different components of the business? And so suffice it to say, you'll get a lot more nuanced about each of these projections. But for our purposes today, you want to start with a model that's simple and then add necessary complexity. Many associates and analysts, they fall into the trap of building out complexity for complexity's sake. And they try and make these magnificent models that are extraordinarily complex. They're hundreds of tabs long, and they spend so much time on the mechanics that they don't stop to think. And so in general, if you can build a simpler model that gets you to a similar outcome, that is much more elegant and much more like superior to a very large and very complex model. So moving forward with this, we've got the projections historically. Now, mechanically, we need to plug these in to the rest of the income statement here. And so the first place that we're going to start is with the revenue, where basically what I'm going to do is I'm going to link up the growth rate down here. I'm just going to say equals E72. And then I'm going to say the prior year times 1 plus this year gives us the growth rate or the revenue. And so you can see that we're projecting to crack $1 billion of revenue this year. We can copy that over to the right. That's going to get us that formula. Now note here that I could use Control R instead of, or I could use, Control C, Control V without messing up this border here, because the border between 2025 and 2026 is on the right side of column D, not on the left side of column E. That may sound like a stupid distinction, but when you're building a model, you typically want to be able to copy your formulas to the right. And so build your models such that the border is on the right side of the last historical year. So next up, we've got COGS. So let's link up again the COGS in the same way. And you'll see actually here, I lied, that we're calculating gross margin, not COGS. So let's go down to the gross margin and then we'll back into COGS the same way. So gross margin, we're going to calculate 75% and we're going to forecast that. And the reason that we calculated gross profit, not COGS, is because typically we care more about gross margin than COGS as a percentage of sales. And so investors and financiers, we think about gross margin all the time. We're calculating it, we're considering it, and things like that. And so we want to make sure that we're calculating it based off of gross margin instead of COGS as a percentage of sales. And so what we're going to do here is we're going to take the 75%, we're going to multiply it by the revenue to back into the COGS, and we're going to see what this looks like over time. So we've got the COGS going from 800 million to 2.6 billion, and then we can back into the COGS, again, making it a negative number. Um, so that it's 268 million. Okay, great. And then I'm going to actually I'm going to build out the percentage of sales formula again and make sure that we anchor this so we can just copy that down for everything. Oh, I anchored that wrong. Okay, great. So I know I'm moving pretty fast right here, but like honestly, this is not like complex intellectual work. This is just hooking up the plumbing of the business. The complex intellectual work happened down here already. Now we just got to hook it up. And so we've got the revenue, we've got the growth, we've got the COGS, we've got the gross profit, all that good stuff. We'll do the same thing for sales and marketing, R&D, G&A, all this good stuff. And so we're going to take the sales and marketing and we're going to say that's going to be this. And then we're going to take the R&D and we're going to say that's going to be this. And then we're going to take the G&A, and that's going to be equal to this right here. And then we're going to, while I'm at it, I'm just going to do the restructuring too. I'm just going to take the restructuring. That's going to be equal to this. And then I'm going to do the operating expenses as a percentage of sales. That will get calculated. So let's stop there for a second. So I just linked up all of these percentages, and now we just got to multiply it by sales. And so I'm going to take this times by sales. And then if I anchor that formula right, then I can copy that down. And I can copy that down. And I can copy that down. And you're going to see basically that I'm just taking 21% times sales. So we've got S&M, we've got R&D, we've got G&A, we've got restructuring. And one modeling hack that I'm showing you here is I actually didn't bother to copy each of those out to the right individually. I'm just going to do it all at once by now doing it and saying control right. And that saves you a couple keystrokes. It's not a big deal, but like when you're trying to get fast, you're trying to get good, and being a little bit faster means the difference between getting out of your model at midnight and getting it out at 11:30. Go get that extra half hour of sleep. Make sure you're able to, go eat a dinner or something like that with your friends. And so do what you can to get these keyboard shortcuts, to get these modeling hacks, all that good stuff. So that gets you down to your operating expenses line. Now, the operating expenses line, actually, we can just copy these formulas over. In fact, we can do that for EBIT too, because these aren't relying on assumptions. They're calculations of the stuff above. And so I'm just going to hit Control Alt V, F to copy the formulas, Enter, and then I'm just going to copy that to the right. And so we can see that the operating expenses are going to be calculating properly. The percentage is going to calculate properly. And then EBIT and the percentage there are going to calculate properly too. And so you can see that once we got the assumptions down, building out the top of the income statement is fast. And frankly, if I wasn't teaching a class, we could have done it in twice the speed, with just fewer explanations and stuff like that. And so that's like how you can start to get these modeling tests done in like anywhere from 45 to 90 minutes or something like that, where you're able to build a full three-statement model, is because it is pretty quick. The only hard part is some of these assumptions. And so just to make sure that everyone's caught up, first off, we linked up the growth rate. We calculated it as prior period times 1 plus the growth rate. Then we linked up the gross profit. We calculated out the gross profit by saying revenue times gross margin. Then we backed into COGS by saying the difference between the gross profit and the revenue and calculated that as a percentage of sales. Then for each of these OpEx line items here, what we did is we dragged out the percentage of sales from the operating expenses assumptions at the bottom, and we multiplied it by the revenue to figure out exactly what this is going to look like before calculating our operating expenses and our EBIT. I know we're moving fast. Hopefully this makes sense. And some of this will end up on YouTube afterwards, but again, pay attention, write down the concepts that you're looking for, and make sure if you want to learn how to model like this, that you do book a call with our team. Happy to talk more about any of the specific concepts or difficulties that you're running into. So next up is DNA. So DNA, as you recall, we basically just said that we're going to make it equal to about 3%. And so I'm just going to copy this up there, and I'm just going to do my linking thing. So I'm going to do Control Alt V L to link that up. And again, I'm going to take my percent or like my sales formula and I'm going to drag that down and that will calculate as a percentage of sales, or you can just take the percentage times the sales. Now, realistically, the G&A probably came down a little too much. Like I don't know that 3% is super realistic because it's going from 40 million to 42 million to 32 million. Like not a huge deal for a $1 billion company to have a few million just like going one way or another. But 3% might be a little low, just so we're on the same page. I'll keep the assumption for now, but it's probably a little bit low. So then next up, we've got GAAP EBITDA. And so this is the important part. This is why we've been doing the forecast, is to figure out what the EBITDA is in the future. And so what we're going to do here is we're going to calculate out the GAAP EBITDA just by copying over this formula, and we're going to see what this trends like. And just because I'm curious, I'm actually going to jump the gun a little bit and drag this all over to the right. And we're going to see that the EBITDA is actually going to become positive in a few years. Now, this is a very important distinct or like concept right here, which is the break-even point. And so we've got the break-even point happening in FY 2029 here. You can see in column H. And so we go from a negative 120 million to positive 60 million that year as the business grows and the margin flips from negative to positive. And that's the incremental impact of changing the sales and marketing, the R&D, the G&A, the restructuring, all these operating expenses, things like that. So then we get down to below the line stuff. So we get to like the net interest expense, all the pre-tax income, all that good stuff. So net interest income, same thing as always. We're just going to link up the interest income as a percentage of sales. And then we're going to calculate that as like a percentage of sales. And so I'm just going to copy down this formula. That's going to pull through. The pre-tax income is going to be a formula. So I'm just going to copy over that formula. The tax rate, we're going to make 21%. And so that one, we're just basically going to multiply by the pre-tax income, et cetera, et cetera. And so then, wait a second, that doesn't look right. Why would we be paying $60 million on taxes if we're losing money? It's a good question. So let's pause here for a second. So just to make sure that we're all on the same page, so we got down, we took our EBIT, and then we calculate our D&A as a percentage of sales, multiplying it by revenue, and then we got down to our EBITDA. We saw that there was going to be a profitability flip. Now we're below the line. So we took out our interest income and we got to EBT, our pre-tax income. So our pre-tax income is still negative at this point, and we're paying taxes. That doesn't make sense. And so realistically, what you typically do in a model here is you say, wait a second, I'm not going to pay taxes if I'm not earning money. Like the government charges you a percentage of your earnings, not a percentage of your losses. And even though there's like a couple $1 million of like strange tax stuff going on historically, which is usually due to the complexity of tax regulation in the many jurisdictions that I'm sure Sentinel-1 is operating in, going forward, we typically in models want to assume that it is um, it is not going to be positive while the operating income is negative or the pre-tax income is negative. And so what we're going to say is basically if the pre-tax income, I'm just going to delete this real quick. So if the pre-tax income is negative, so if it's less than zero, then we're going to have this be zero. Otherwise, we'll make it 21% of this. And so that means that this isn't going to be a positive, or like we're not really going to pay taxes until we become profitable in 2029. So I'll show you that formula one more time. Basically, what we're saying is that if we're losing money, the government's not going to charge you taxes. In fact, you're going to generate net operating losses, which is another technical finance concept that we don't need to get into right now. And so what we're doing is we're creating a conditional where we say if the pre-tax income is negative, then it's 21% of the pre-tax income, or it's zero. Otherwise, it's 21% of the pre-tax income. And so you can see what that looks like. We start generating taxes in this year, and that's going to be negative. And so I'm actually going to flip this one more time because I want the taxes to show up as an expense. Okay, so then last but not least, we calculate our net income. So we've got our pre-tax income, got our taxes, and we're going to calculate these out, and that's going to get us to our net income. Okay. So I'll pause there for a second. I know that that formula is a little bit tricky on the taxes. And so let's take a second. Let's think about that for a thing. We're basically saying if it's negative, then we're not going to pay taxes. If it's positive, then we are. Okay. So with that, we've gotten down to net income, but we've got a couple other things that we still need to do, which is CapEx, capitalized software, and then our cash EBITDA. So CapEx, this one's pretty simple, where we've basically got the 0.5%. And then we've got our capitalized software, which is this 2.5%. We'll link those back up. And then we're going to multiply these by sales. And so in the same thing as the depreciation formula up here, I'm just going to copy this at random where it was percentage of sales times the sales. I'm just going to take this down here and do the same thing for CapEx and for this. Now, realistically, let's see if I mess something up because that looks like a pretty big jump. But again, it's small dollars. It's like going from 2 million to 5 million. So not a huge deal. Not going to mess with it too much. But we might typically want to see that as like a slightly smaller jump. I'm not going to change it right now. But just note that you're looking at things on percentage basis and dollar basis. Then capitalized software, that looks about right. It's increasing a little bit. And so I'm just going to copy these over. We've got the capital, we've got that, and then we've got our EBITDA, yada, 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 copy over the formulas, and I'm just going to take this all to the right. And so let's talk for a second now that we've projected this out about like what the difference is between like this GAAP EBITDA concept and this GAAP cash EBITDA. Well, realistically, I think the GAAP cash EBITDA, I have messed up the formula here a little bit, where the GAAP cash EBITDA is basically taking the EBITDA and subtracting out a couple of these other cash expenses. So please go back and let's correct that formula that I did historically here to say EBITDA minus CapEx minus capitalized software. And so conceptually, what we're saying here is we've got this EBITDA metric, which is like our proxy for profitability. EBITDA is technically not a GAAP metric, even if we are showing it as GAAP here. And so in order to make it more useful for us, we subtract out some other capitalized expenses and capitalized software and capitalized expenditure to get closer to a proxy for like what cash flow is. And so we're going to take our GAAP EBITDA, subtract out our CapEx, subtract out our capitalized software, and that's going to get us to like this fake metric of like GAAP cash EBITDA. Now, a lot of investors do use an invest or like a cash EBITDA metric, but typically they'll call it non-GAAP cash EBITDA. And that's a distinction that we're not going to get into a ton today, but I do want you to be aware that to get from GAAP EBITDA to non-GAAP EBITDA, you're going to have to add back a lot of those one-time expenses that we talked about on the 8K. And so that's a much more complex topic that I would love to get into at some point with you, but that's not appropriate for the level of complexity that we're looking for today. So suffice it to say, GAAP EBITDA is like a simplified metric of profitability. Cash EBITDA is another metric that's designed to help that figure out. So let's recap what we've got here. We've got a historical and projected period where we've got the revenue, we've got our costs of goods sold, and then we've got our gross profit, our sales and marketing expense, our R&D, our G&A, our restructuring expense, gets us down to our operating expenses and our operating income slash EBIT. We add back D&A to get to EBITDA. And then we also go down to get to net income really quick, where we take the EBIT and we subtract out the interest income, we subtract out the taxes. We did that little tax formula earlier. And then we go from EBITDA to cap cash EBITDA. So this is our projected income statement. And this is going to be extraordinarily important for the rest of the financial model. Now you'll notice that over to the right here, we've got a calendar year versus a fiscal year. So let's spend a second just talking about this. So what you can see here on the calendar year is we've got basically December 31st calendar year ends. On the fiscal year here, we have a fiscal year end of January 31st. And so this is important to understand because Sentinel-1 actually has a fiscal year end that's not the same as a calendar year end. And this is one of the most annoying things. This is one of my pet peeves in finance, is the fact that a lot of companies, for whatever reason, just to make our lives hard, I think, they decide to make their fiscal year end different than the calendar year end. And so what Sentinel-1 has done is they say, okay, like we're going to close our books on January 31st instead of December 31st. And so when we say 2026, what we actually mean is the last 12 months ended January 31st, 2026. And so in fact, as of today, fiscal year 2026 for Sentinel-1 is over, even though 2026 on a calendar basis has just begun at the time of this recording. And so what we need to do as investors is if we want to compare Sentinel-1 to CrowdStrike, to Fortinet, to Palo Alto Networks, we have to make sure that we're looking at the same time period. We have to make sure that we're talking about like the exact same year. Now you might say, okay, but like, what does it matter if it's off by a month? Well, like, imagine if COVID happened during that month. Like, do you remember what happened when COVID hit and like all the supply chains were messed up and like, people stopped shopping and stopped going to the movies and things like that? Like, if you're trying to compare two movie theaters, one of which has a fiscal year end that ends right after COVID and the other ends right before, one of those is going to be much more dramatically impacted than the other. And even though it's a short time period, it's not going to be an apples to apples comparison. And so in the same way, we want to make sure that we're comparing our comps on the same time frame as each other. And so if we're using a fiscal year end of January 31st, we either need to make sure that everything else is on a January 31st fiscal year end, or more likely, we'll make Sentinel-1 on a calendar year end and make everything else on a calendar year end. And so I'm not going to get into the mechanics of how to do that right now. If we have time at the end, I'll come back and we'll talk about this section right here. But for now, let's move forward with our calendar year metrics and continue from there. So that is our income statement, folks. We spent about 45 minutes on it, and we have another hour and 15 minutes to crank through as much of the cash flow statement and the balance sheet as we can. So take a second, get caught up on that, and then let's move forward. Next up is the cash flow statement. And again, I remember that this doesn't look like a cash flow statement. In fact, it looks like a component of a balance sheet. But realistically, all we're trying to get here is the changes in net working capital. Like that's the important part for the cash flow statement that we don't already have. And so just to give you an insider sneak peek on how investors actually think about the cash flow statement is we really kind of only care about a few items. We care about our CapEx, which we've already calculated over here. We care about capitalized software expenditure, especially if you're a tech investor, and we've already calculated that. We care about our like accounts receivable and our other current assets. We care about our accounts payable and payroll benefits and liabilities and things like that. And we're already going to calculate all of that stuff as components of our net working capital. And so even though this looks like a part of a balance sheet, in fact, what we're working towards is the piece that we care about with the cash flow statement. And yes, we will use some of these items on the balance sheet and we'll copy those over. But for now, I'm calling this a cash flow statement because it's going to get us the last piece that we need to determine what the change in cash is for the business. So with that context, let's take a look at that and begin working on it together. And so I'm going to flip open my screen again, and I'm going to pull open the cash flow statement on the right here. And so we're going to, in the same way that we were linking up the income statement, we're going to link up the cash flow statement as well. And so historically, we want to make sure that we've got the right accounts receivables and we've got the right other current assets, all that good stuff. And so the accounts receivables here, what I'm going to do is I'm going to link these over to, where is it? There it is, accounts receivable. So I'm going to take these and I'm going to make sure that I'm copying these over. In fact, actually, I'm sorry, we shouldn't be looking at the cash flow statement. So since we're not looking at the change, we're looking at the absolute amount. Let's pull these from the balance sheet right here, which is going to be the 214 and the 236. So I'm just going to do that linking trick again, where I'm going to say Control Alt V, and then I'm going to paste as a link. Now, unfortunately, my Excel seems to be crashing a little bit, so I'm just going to open that window again and see if that will let me do that. Okay, let's try this one more time. Accounts receivable, and then do Control V, link. Okay, great. So we've got our accounts receivable going forward. And I'm just going to say again, if you fell behind on the income statement, no worries. Just watch, follow along, try and catch up afterward if you want, or you can build along and behind us. So we've got our accounts receivable here. Then next, we're going to link up our other current assets. And so as we look through this assets section, we've got to figure out like what of this feels like working capital, like which parts of this are actually operating and related to the concepts of the business that we should be dragging over to the cash flow statement. And so obviously our accounts receivable is super important on that. Like that's going to be useful. But then as we go through, like what about deferred contract acquisition costs? Like what does that mean? Like what is that? Like is that important or should we be doing that? What about like prepaid expenses? Should we be including that? Like, what about like anything else in this section, short-term investments, cash and cash equivalents. Like, well, we know cash and short-term investments aren't operating, so those aren't going to be part of working capital. But some of these things you probably need to go look up. Like you probably need to go figure out like what is deferred contract acquisition costs. And that's going to take us back to the 10K where we have to go and like control F for like deferred contract acquisition costs. And I'm not going to do that right now. For now, we're just going to assume that that's not part of working capital. But on the job, you're going to want to go through each of these line items and figure out and think conceptually, is this working capital or not? So we've got our accounts receivable. Let's just call the only other working capital this prepaid expenses, which we know is going to be working capital. So we're going to copy that over as well. And then we can calculate our working capital assets. So we've got our accounts receivable linked from the cash flow statement. We've got our other current assets linked over. We've got our working capital. Then let's look at the liabilities. And so here we're going to go find a few of the liabilities. And so we're going to go read through and we're going to say, okay, accounts payable, that looks like a working capital liability. That's a classic liability. Let's copy that over. Now, accrued payroll, that's also a liability. So basically, it's like you owe your employees and you've got to pay them even though they haven't actually, like even because they're doing work right now, even if they haven't been able to afford it or you haven't been able to pay them. And then other current liabilities, we're also going to call that one part of net working capital liabilities. And so I'm going to link that up really quickly. And then last but not least, we're going to link up the deferred revenue. Now, the deferred revenue here is a little bit tricky because you see we've got this current and we've got this non-current component. Now, realistically, most of the time, like 90% of the time, we only care about current assets and liabilities in terms of working capital. But for some businesses, especially software businesses that sell multi-year contracts, we actually are going to care about current and long term. So this is not something that you need to like super understand right now. You can just trust me for now and then go and learn about this more advanced concept later. But for now, for deferred revenue, include this 399 and this 114 for 2026 or for 2024, and then copy that over for 2025. And I can get into the rationale behind that, but basically what we're trying to understand is what is the actual working capital of the business. Now, one more fun Excel trick here is the easiest way to do a sum formula is to hit Alt equals, and it will create an auto sum of whatever is above it. And so in that case, I'm just going to auto sum the stuff above it. On Mac, that's Command Option equal will auto sum the stuff above it. So I'm going to hit Alt equal on that. I'm going to hit Alt equal on that, and we'll see what our working capital is. Okay. So we've got our historical working capital assets. We've got our historical working capital liabilities. And again, just to highlight out the one complex part of it is the deferred revenue includes current and long-term liabilities of deferred revenue. And then we're going to take our net working capital. And so our net working capital here is basically going to be the difference between our current assets and our current liabilities. So we're going to take the current assets, we're going to subtract out the current operating liabilities, and we're going to get to our net working capital of about negative 400 million. Okay, so that's balance sheet stuff. That's great. That's like what the balance sheet has in terms of assets and liabilities. But we're working on cash flows right now. We're trying to figure out what actually happens to the cash flow statement. And that's where the next line becomes the single most important line on this sheet, which is we're trying to figure out the change in this. And so we're trying to figure out the change in the net working capital between these businesses. And so what I'm going to do here is I'm going to take the 432, I'm going to subtract out this, and that's going to tell us that the net working capital increased or decreased by about this amount. And so what that means is that on the whole, our assets increased or decreased by about 30, 40 million or something like that from year one to year two. And our liabilities increased by about, what is that? 10 million. And so one of those is a source of cash, the other is a use of cash. And ultimately, what this means is that we've decreased our net working capital by about this amount. And so that means that ironically, this decrease in net working capital is going to be a use or a source of cash to the business. And so when assets go down, that means that we have fewer receivables, like we collected more cash. Our other current assets went down, like we have more cash. And then on the liabilities, It's like we ended up not paying our suppliers as quickly, and we ended up collecting more deferred revenue. And so that means that we generate cash from our working capital. And so this is hard to wrap your head around. A lot of people mess this concept up when they're building LBOs in particular. But this right here is going to be a source of cash. So let's figure out how to project this going forward. And in order to do that, we're going to need to know what the revenue and the COGS are. And so I'm going to go back over to the income statement, and I'm just going to copy this whole row. So I'm just going to do Control Shift right arrow to copy the row, Control C, pop back over, and then Control Alt V to link it here. And because it's on a blue background, I'm not going to make it green, even though theoretically it should be because it's an intersheet formula, because it'd just be too hard to read. Then I'm going to do the same thing for the COGS. Now, why the revenue and the COGS? Why am I bringing these over? Well, because those are the two things that we use to forecast our net working capital primarily. So let's talk about each of these in turn. And again, if you've fallen behind on the model, don't worry, just watch along and you can learn a lot of these concepts as I talk through them. So you're still going to learn a lot even if you're behind on the model. So let's take a look at what we've got going on here. So what we've got here is we've got mechanisms for forecasting our net working capital. And so on this, we've basically got this concept called AR days. And basically the AR days is basically saying how many days of accounts receivable do we have outstanding at any given time? And so like how much time does it passes between when we give someone their iPhone and when they pay us for it? And so the way that we calculate that is we say, okay, what is our accounts receivable right now? What is our revenue right now? And so that means that like basically, we've got 200 divided by 600. So 1/3 of a year of accounts receivables outstanding. So we've got $200 million of accounts receivables. We've got $600 million of revenue. That means that it takes usually about 1/3 of a year to collect all of the accounts receivable that we have. It happens 3 times per year. So to translate that into days, we're going to multiply that by the number of days per year. So I'm just going to multiply that by the cell up here, which is a named range for days. And we're going to see that we have about 126 days of accounts receivable outstanding. Then in 2025, it looks like that goes down to 105. And so then what we're going to do is we're going to calculate out the rest of these, or we can actually forecast this one right now. And so I'm just going to copy that over and then let's forecast that. So let's say that, this goes down to 100. We'll make it a smooth ramp. So we'll say 103, we'll call it 100, and then let's hold it flat from there. And so let's say that we've got basically 100 days outstanding for accounts receivable. Then the next thing that we need to do is actually go and see what this means for accounts receivable. So over here for accounts receivable days, we took accounts receivable divided by revenue multiplied by 365. Here, what we're going to do is we're going to flip that. We're going to say 103 divided by 365 multiply by the revenue. And the intuition here basically is saying that we're trying to calculate the portion of a year of revenue that we haven't collected. And so if we have 100 days outstanding and there's 365 days a year, it's like about 1/3 of a year that we're projecting is going to be captured in accounts receivables. And so we take 1/3 of a year multiplied by the revenue, and that gets us a couple $100 million of accounts receivable. And a quick sense check is to like look at it and see like, does this number look crazy? Like is this like hugely different than the historical period, or is it approximately similar? In this case, it goes from 200 to 250 to 300. Like seems pretty reasonable. So then let's take a look at other current assets. So other current assets as a percentage of sales, basically what we've got to do here is we've got to take the other current assets here and divide it by revenue. And this is a very simple forecasting methodology where we basically say our other current assets are just going to grow in proportion with sales, and we don't need to worry about it too much beyond that. And as you can see, this has been highly variable. It went from 16% to 6%. And so what we're going to do is let's just hold it flat at 6% from here. We don't have a great sense of how that's going to change, and so we don't want to be falsely precise by trying to make that something dramatically different. So We've got our other current assets as a percentage of sales. Then the next step is to take that other current assets and multiply it by the sales to get to our other current assets. And so basically what we did is we took other current assets divided by sales to calculate a percentage. And then now we take the percentage times the sales to get to the other current assets. And that's going to get us our working capital assets of this amount, 360 million. Hopefully that makes sense. And then next up, excuse me for one moment, I believe I have accidentally hit the Zoom magnification function. So I'm going to stop sharing and remove that. And I'll let everyone catch up while I figure that part out. Okay, great. So took the percentage of sales, multiplied it by the sales to get the actual accounts or current assets, other current assets. And so this other current assets, like there's a ton of stuff that goes into there. I wouldn't like worry about too much of it. Like realistically, you want to stay focused in your modeling on the things that matter a lot. And so the accounts receivable is like 5 times as big as the other current assets. It's 300 versus 60 million. And so you want to spend 5 times as much time thinking about the assumptions and thinking about what it means. But for now, let's take these, let's copy them over, and we can see how it grows. And so you're going to see that the accounts receivable is going to skyrocket. The other current assets is going to skyrocket because the business is growing substantially. Now, let's go turn our attention to the current liabilities. So the current liabilities here, basically what we're going to do is we're going to try and calculate out the accounts payable days, the accrued payroll benefits, other current liabilities, and change in deferred revenue. So we've got 4 things to do. One of them is a days method of forecasting, and the other 3 are just as a percentage of sales. And so these 3 are going to be easy. This one's going to be hard. So let's start with the days. So same as accounts receivable days, we're going to calculate the accounts payable relative to another financial metric as like a percentage of a year of that financial metric. And so with accounts receivable, we did that as a percentage of sales. With accounts payable, though, this is related to the costs that we're paying to our suppliers. And so it's not actually linked to sales intuitively, it's linked to COGS. And so we're going to take our accounts payable expense, divide it by the COGS, and then multiply by the days. And then we're going to make that a positive number. So I'm going to say negative version of that, and that's going to get us to our accounts payable days. And so then we can copy that over and we can see how that changed. It went from 14 days and okay, it stayed flat at 14 days. So let's continue that. We'll keep it at 14 days per. And then up here, we're going to reverse that formula. We're going to take the 14 divided by 365 and then multiply it by the COGS, not the revenue. And then we'll need to make that a negative, so it's like the right sign. So our accounts payable is going to be about 10 million going forward. And I'll just say that formula one more time. It's the days divided by 365 multiplied by the COGS, flip it to a negative, so it's a positive number here. Then accrued payroll and benefits, other current liabilities and deferred revenue, we're just doing as a percentage of sales. And so I'm just going to crank these out pretty quickly here, where I'm going to say this divided by the sales is going to be X percentage. And I'm just going to link that again. I'm going to copy, or I'm going to hit F4 to make sure that the row is linked, but not the column. And so that's going to link the row. And then I'm going to copy down all of these formulas here. And then I'm going to do that as a percentage of sales. And so we've got that going right now. That looks pretty good to go. And basically, what we've got is a pretty nice formula for figuring out the accrued payroll, the other current liabilities, and the deferred revenue. Now, one thing that we've actually got to note is that unfortunately, the deferred revenue is a little more complex than that, where you can see that the name here is the change in deferred revenue as a percentage of sales. And why we do this comes back to what the nature of deferred revenue is. We're basically saying that each year that we're selling something, if we collect the revenue up front, then that creates deferred revenue. And so in this case, that's going to be based off of the change in deferred revenue. And so we're actually going to delete that one, and we're going to say that the change in deferred revenue divided by sales is equal to, is the forecasting metric that we're going to be using here. So I'm going to take that and minus that divided by sales. And so that one's slightly more complex. So I'll show you that formula again here, but that's going to be based off of the change in deferred revenue as a percentage of sales, so you can calculate those out. And so that's going to be pretty straightforward, hopefully. And then now for the forecasting, what we're going to do is we're basically just going to hold these at, some sort of flat-ish rate. And so for this one, we could call it anything, but I'm just going to hold it flat, the average of these two. And so I'm going to say that's going to be equal to 10.8%. You could call it 10%, you could call it 9%, you could call it 11%. Like nobody really cares. It's going to be approximately correct, but we'll start with an average. Then for the other current liabilities as a percentage of sales, like that changed a lot. So it went from 18% to 7%. So I'm just going to pick a number here and I'm going to say, let's hold it flat at 8%. That's an arbitrary assumption, but you typically want to make sure that it's like reasonable, it's within the range, and maybe there was just like a temporary dip in this year for the other current liabilities. Then for the change in deferred revenue, also just going to hold that flat at about 7%. I'll copy this formula down and we'll have that to go. So for now, we've got all of the stuff we need to project it. Now we just need to actually go and project it. So for accounts payable, we already did that. For accrued payroll and benefits, we did this as a percentage of sales. And so it's going to be super simple. We just take the percentage of sales multiplied by the sales. And I'm going to lock that row because, in fact, we can drag down that formula right here as well. And so we did the other current liabilities as a percentage of sales. And then last but not least, we're going to calculate out the deferred revenue, which this one is going to be a little bit more complicated, where basically what we're going to do is we're going to take the deferred revenue from the prior period plus this percentage times the sales. And the reason that we're doing that here is remember that we calculated the change in deferred revenue as a percentage of sales, not the deferred revenue as a percentage of sales. And so what we're doing here is we're taking the deferred revenue and then we're adding on the percentage of sales. And so we're saying that like basically 7% of our sales each year are collected as like deferred revenue on top of whatever our existing base of deferred revenue is. And so that's going to translate into deferred revenue. And there's a lot of different ways to calculate this. Don't fixate on this specific method of calculating deferred revenue, but ex post facto, when we look at it, like it looks about right. We're going from 515 to 570 to 650, like it's directionally correct. So I'm going to run through this one more time. For accounts payable, you take the accounts payable days, divide by 365, times by the COGS. For accrued payroll and benefits, you take the percentage times the sales. Then for the other current liabilities, same thing. And then for deferred revenue, you basically take the prior plus the percentage times the COGS. So that's going to get us roughly what we need to calculate our deferred capital, our net working capital, and our increase and decrease in net working capital throughout the projection period. So let's sum that bad boy up, copy it over, and then calculate out the net working capital and the increase or decrease thereof over time. So the net working capital here, we can actually just copy this formula. And what we're seeing is that the working capital liabilities are going to be growing much faster than the working capital assets. And so that means that in general, we're going to generate significant amounts of cash from our net working capital. And this is a unique phenomenon specific to software businesses, where as the business grows, because deferred revenue grows for multi-year contracts, the business is going to generate more cash. Now, for a lot of other businesses, it's the exact opposite, where when the business grows, they're going to actually consume a lot of cash because you've got to buy inventory and you've got to buy iPhones and you've got to like build stores and like hire employees and pay the payroll and things like that. No. For software businesses, it's the exact opposite. And that's why software businesses are so attractive to investors because of this working capital dynamic. So I'll pause here for a second and just recap what we did, make sure that everyone's caught up on the formulas before we move on to the balance sheet for the last 50 minutes of our time together. So for accounts receivable, we're taking the days divided by 365 multiplied by the revenue. For other current assets, we're doing it as a percentage of sales and forecasting that going forward. And then I already recently talked through these. So I'll pause for a few minutes here to see what questions you have on these. And to start with Sahil's question, I'm going to say other current assets formula is going to be this one right here, where it's basically other current assets divided by revenue. And then forecasting is just going to be 6% times the revenue going forward. And then for the accounts payable forecast, this one basically was done as an average of the historical period. And so Nick, we basically took accounts payable divided by, or sorry, oh, I'm so sorry. I was reading accrued payroll, or accrued payroll. So accounts payable, basically this is the accounts payable divided by COGS multiplied by 365. And I flipped it as a negative so that that would work effectively. And then going forward, I held that equal. And then I flipped it here where we said accounts payable divided by 365 multiplied by the COGS. And then for accounts payable days, basically what this is this is the intuition here is we're basically saying, okay, we've got X million dollars of accounts payable. What percentage of a year's COGS is that? And so if we've got 7 million of that and we've got $180 million of COGS, then that's going to be approximately, what is that, like 5%-ish or something like that, like 4%. We can actually just calculate that. 14 divided by 365. Yeah, so that's gonna be, yeah, 4%. And then we just multiply that by 365 to get to like, it's about 2 weeks of accounts payable outstanding at any given time. So it's not huge. And then last but not least, accrued payroll and benefits. Basically, this one is very simple. It's as a percentage of sales. And so we take the accrued payroll, divide by the revenue. And then in the future period, when we've held that flat at the average of those 2 years, then we just multiply that again by the sales. And then deferred revenue is the complex one. So we brought that in from the cash flow statement where it was the current and long term. And then we basically calculated the change in deferred revenue as a percentage of sales and then made that going forward multiplied by the sales and we added it. So we said deferred revenue plus the change or plus the percentage of revenue gives us the deferred revenue. And again, that's not the only way to calculate this. Maybe the right way, maybe the wrong way. Like there's different opinions on this, but that is the way that we can calculate together today. And it achieves an approximately correct outcome that seems like a smooth growth rate in the amount of deferred revenue. And so let me double check to make sure that we've got everything correct here. Take a look at the accounts payable in particular. Looks like I may have calculated, did I calculate that one right? Yeah, I think so. Let me just, yeah. Happy to take a look at that, Sahil and Nick, if you think that my formula is wrong, but I'm moderately confident it's correct. So I'll pause there for a second. Okay. Any other questions on the cash flow statement? Change in net working capital? Oh yeah, yeah, I copied over the number. Thank you for catching that. That's exactly. So that's going to be the 14, and then accounts payable is this, and then net working capital is basically going to be the working capital assets minus the working capital liabilities, and then the change is just going to be period 1 minus period 2 net working capital. And then the deferred revenue formula I'm going to show one more time, and then we're going to move on to the balance sheet. So this will be here. Give it 30 more seconds, and then we're moving on to the balance sheet, folks. I'm excited. We'll see if it balances. Okay. Great. So let's move forward here. I know that this is tough, and we're going to include the completed version of this Excel in the same file that I originally sent over just for you. So please don't distribute it. So next up is the balance sheet. So let's take a look at what we've got here, and we're pulling everything together. And so basically, we've got like an income statement, an abbreviated income statement, abbreviated cash flow statement down here that looks more like the cash flow statement that you're expecting, and then a balance sheet, basically. And this is going to be a very simplified balance sheet. And so now is the time to take all the stuff that we've built in the other statements and bring it into like a cohesive, classic three statement model. And so that's going to be very, very common to see something like this, where basically a lot of times in financial modeling, we'll build out the income statement, we'll build out like some of the stuff that we need, and then we'll pull it together into like a central tab that shows the three statements, the income statement, the balance sheet, and the cash flow statement. And so fundamentally, this is kind of like a conglomerate tab, but we're going to pull in the balance sheet and we're going to pull in a cash flow statement similar to what you're expecting already. So let's just do a bit of a linking exercise. And honestly, you can probably skip linking the income statement with me because that's mostly just for aesthetics and for visuals here. Pay attention, get started linking on the balance sheet and the cash flow statement to the other tabs for now. But for now, just for your benefit, I'm going to go ahead and link through the revenue so you can use this time to catch up because realistically, you don't need to link this back up here. This is just mostly for practice linking and so that we can use this if needed on the statements below. So I'm going to take the revenue, just got to link this over. Let's see how many years of projection. So here on this one, we're only doing 4 years. And you can debate whether you want to do more, you can drag it out, it doesn't really matter, but we're just going to do 4 years for here. And then I'm going to calculate over the growth. I'm going to copy paste that and I'm just going to move super fast. No need to follow along unless you'd like to. Calculate over the COGS. And then we're going to get to our gross profit. And so I'm just going to take this, I'm going to take that and the gross profit margin. I'm going to copy those over. You could technically calculate it again. So since it's black, I'll turn it into a formula. So I'm going to take that plus that and then calculate the formulas, multiply or figure out what this is based off the percentage of revenue. And so this is a good chance for those of you who are still getting caught up on the income statement to take a look at how I'm building these formulas and basically redoing everything we did just quickly to like pull it together into like this output tab. And then we've got our operating expenses. And so that's just going to be the sum of all of the operating expenses over here. And so that's going to be like our sales and marketing. That's going to be our R&D, our G&A, and this restructuring expense, especially for 2024. And then I'm going to copy that over and then calculate that as a percentage of sales. And then copy that down. And again, no need to follow along on this specific part because realistically, this is just for display purposes because a lot of financial modeling, like honestly is just to like build an output that like you can show to your managing director or something like that. Then I'm going to copy over the DNA, get that into the other sheet and then copy down the percentage of sales. And in fact, while I'm at it, I'm just going to copy down the percentage of sales for a lot of these because we can also use this for the percentage margin there, the percentage margin there, the percentage margin there, and the percentage margin there. So that'll save us a little bit of time. Then our DNA, we'll calculate it, is basically going to be the gross profit minus the operating expenses plus the DNA. Like you should remember that formula by now. And we'll just copy over just to make sure that that's correct. And yes, that looks like that is correct. And then I'm going to make that bolded so that that looks good. Um, and then next we're going to link up the DNA because we've already got that up here. And so we take out our EBITDA, we subtract out the DNA, that gets us to our EBIT. And then I'm going to paste that as a formula. And then we'll get to our EBIT. And so that's going to be basically the EBITDA minus the DNA or plus the negative in this case. And so that's going to be our EBIT. And then we'll just double check that that matches what we have over here, which it does. On the other tab, you can see that it's like kind of matches up like with this number in the outer years. And so I'm just like checking everything as I'm going along and I'm moving fast. I might be making a mistake right now, but realistically, since this is just for an output, it's not going to matter as much. And so then next is the pre-tax income. Copy that over. We've got our tax expense. Copy that over. Not going to really be paying taxes until we become profitable. And then basically, so I got to go copy that. And then our net income is going to be equal to the sum of the pre-tax income, the pre-tax income, tax expense. And then that's going to get us our net income. And we'll just double check that that matches, which it looks like it does. Okay. great. So we've got our net income. That's great. Um, and that's basically a little bit of time for you to catch up and make sure that you're on a good page. So now we're going to get to the actual heart of calculating out what the balance sheet and the cash flow statement looks like. And so this is going to be important, and you're going to start to see the stuff that we've been talking about over the last couple hours come together in a really cool way. So first off, for the cash and investments, basically what we're going to do is we're going to say that for the historical period, we already know what that is. Like we've got that from our cash flow statement and from our balance sheet. Like we know what that's going to look like. And so we're going to take the cash and investments and we're going to link that up with the historical balance sheet. And so I'm going to pull open the historical balance sheet on the right side, and we're going to start linking up some of the balance sheet items. So the cash and investments, we're going to link up over here. That's going to be that piece right there. Then the accounts receivable and the other current assets, like we already actually linked up in the cash flow statement tab, but I'm just going to relink them directly to the source. Sometimes that's better than trying to play a game of telephone where you link it from the source to the cash flow statement to the balance sheet. You might as well just link it back to the source so you can change it only in one spot and you know it's going to flow through correctly. Then other current assets, we're basically going to sum up a bunch of this other stuff. So we've got the cash and cash equivalents. Oh, I'm so sorry. The cash and investments actually does need to include the short-term investments here. So we've got to do the cash and the short-term investments. And so that'll get us to what we're looking for there. And then let me just make sure that we're not missing any other investments. Well, actually, now that I think about it, we've got this long-term investments down here as well. And so we've got the cash, we've got the short-term investments, and then we've also got these long-term investments down here. And so I'm going to take that, I'm going to copy it over. We've got the long-term investments. Okay, great. Hopefully that makes sense. And then we've got our accounts receivable. And from there, we've got our other current assets. And so the other current assets is basically just going to be everything else that we haven't already included in the other components. And so that's going to be equal to, and in this case, we're actually going to do a simplified version similar to what we did on the cash flow statement, where we said that other current assets was just equal to the prepaid expenses. And so again, we're leaving out random stuff like the deferred contract acquisition stuff, and that's going to come into this plug right here, which is going to be like a simplifying assumption that we're making to help our balance sheet balance that's going to plug some of these other things. So we're simplifying the balance sheet as much as possible to make it balance, and we're just looking at the parts that we care about. And so the other current assets, I'm just going to link up to this prepaid expenses here. Because in this case, that's just kind of what this is. So we've got our prepaid expenses, and then we've got our goodwill, which is this component down here. That's big enough that we're going to like break it out separately because it's freaking $500 million. Like it's huge. And then the PP&E and others is going to be a plug. And so when I say a plug, what I mean is it's something that's like the difference between a total and the sum of everything above it. And so what we're going to do is we're going to take the total for our assets, and then we're going to back into what the plug is. And so we're going to take the total assets here, the 2.3 billion, the 2.4 billion, and then I'm going to take a plug here of this minus the sum of all this, and that's going to get us what the PP&E and other assets are going to look like. So let's stop for a second, take a look at that, and we'll see if you can catch up with the plug as well. And we may need to adjust this just a little bit down the line to make sure that everything balances appropriately. We'll make as many simplifying assumptions as we need to, but let's start there for now. Then we'll do the same thing for the liabilities and stockholders' equity. So we're going to start out with the accounts payable here. And so we've got the accounts payable that we're linking back over. So that's going to be the 6 million, 8 million. We've got the deferred revenue, which is going to be equal to the sum again of the current and the non-current deferred revenue. So it's going to be this bit and this bit. And then we're going to take our accrued payroll and benefits, which is going to be equal to this bit and this bit. We've got our other current liabilities, and so the other current liabilities are going to be equal to the sum of this little bit right here. So actually we don't need to do a sum. We can just calculate this and then calculate that over. And then the shareholders' equity, we're basically going to put at, let's see if we can figure out where this is. This is the stockholders' equity right here. So we're going to take that, we're going to copy that over. That's going to be the shareholders' equity. So we've got our liabilities here, and let's just sum this up to make sure that it equals. And it looks like we've probably missed a couple little things. And so when we look back, yeah, it looks like we've got like this other liabilities component here. And so what I'm going to do here is I'm just going to call this other liabilities total. And so current, um, I'm just going to remove that. And then we're going to make that equal to the other current and the non-current liabilities. And so that's going to get us to what we've got there. Let's just see if our balance sheet is going to balance historically. And historically, in fact, it does balance. And so that looks like that should work. And then if we wanted to, we could also just like do a quick double check to make sure that historically this is going to balance, where if we take all this other stuff, it should equal up to like 324. And so while the rest of you are catching up on these formulas, I'm just going to like double check and just do a quick sense check to see if everything that we didn't calculate does sum up to the 324. So we take the PP&E, we add in this, we add in that, we add in, I think we have the other, then if we look down in the corner here, this sum right here does equal 324. So you can see that in fact, this plug that we did is accurate. It's basically just a shortcut that we take where we don't want to go and sum up like these 5 items or something like that. And so we're going to take the total assets of 2.3 billion, subtract out the stuff that we are doing, and then we've got like this random potpourri of stuff that we're not just going to immediately calculate. And so hopefully that makes sense in terms of like why we did it this way for the plug. But long story short, assets equals liabilities plus owner's equity. And so hopefully that makes sense. You've just got to make sure to get the current and the non-current in a lot of these things. And honestly, how you bucket these things doesn't matter as much as the fact that you bucket them correctly. And so, for example, we could break out other current liabilities and other long-term liabilities on this balance sheet. We could break out current deferred revenue and long-term deferred revenue. And we could have like a current liabilities and then a long-term liabilities and an equity section. We could break out the different components of equity. Like we could do all of that. But we're not going to because we're being simple here. We're simplifying. We're making this as intentionally simple as possible. Um, and we might even be like leaving out like 27 bucks of like common A stock or something like that. Like, and I'm just going to simplify it as much as possible, as ruthlessly as possible right now, just to stay focused on the concepts that we actually care about. So for this here, I'm going to say, okay, does the balance sheet balance? So we're going to take the current assets minus the current liabilities, and historically, it does. And so that's a really important check just to always have. Now, though, we've got to get into the heart of forecasting these things. I'm going to move a little bit quickly here. So the easiest one to forecast are the ones that we've already forecasted on the cash flow statement. And so on the cash flow statement here, we're going to start out with the accounts receivable. And so the accounts receivable here, we're going to take this, we're going to just copy open these years right here. And so we're going to copy that over. We've got that good to go. Great. Then next up, we're going to copy over the other current assets that we've got here on the cash flow statement as well. And so these are the low-hanging fruit because like we've already calculated this. This is already coming from the other things. Great, easy, easy. Cash, that's going to be hard. We'll come back to that. Some of this other stuff going to be a little harder. We'll come back to that. Now, for the goodwill and PP&E and other, a lot of times the simplest thing that we do is we just hold it flat. So I'm just going to hold it flat. I'm going to say, hey, we're going to hold this flat from the historical period. And that's going to be the simplest way to forecast that. And for other current assets and PP&E and stuff, like theoretically, you could do this like as a percentage of sales. You could grow this. That would be a little bit more accurate. But for goodwill, honestly, because goodwill relies on like acquisitions and step ups and things like that to calculate, you're probably never going to really calculate out too much goodwill in your forecast. And so here we're basically just going to hold that flat going forward. And so then, we'll sum up our balance sheet. We'll say that this is going to be equal, the assets is going to be equal to all this stuff. And we don't have the cash yet. And so we know this is going to be a little bit off, but we'll come back to the cash. So then next up, we've got this accounts payable. And the accounts payable, again, we already forecasted over on the cash flow statement. And so I know that earlier it's like you're like, oh, you're looking at this cash flow statement, you're like, that looks kind of like a balance sheet. And I'm like, yeah, there are a lot of similar components, and we need some of the components of the balance sheet to match over to the cash flow statement. And so we are, in fact, doing a little bit of that to make this work. And then I'm going to calculate over the deferred revenue, and we'll copy paste that. And then we'll do the same thing for the accrued payroll and benefits. We'll do the same thing for the, do that. And then the other current liabilities is going to be like slightly messed up because we've got other current liabilities plus like this other component of liabilities. And so that's going to throw us off just a little bit if we copy this over. And so this is going to be like slightly different. And so I'm just going to mark this right now as a highlight for something that we can talk about and come back to as needed. And then the shareholders' equity here, I'm basically just going to say that this is equal to the prior period plus the net income up here. And like if you didn't have the net income up here, you could link back over to the income statement, but that's part of why I included the net income on this tab, just so you can see how that flows through clearly. And then that's going to get us our total liabilities and equity. Okay, so as you can know right now, the balance sheet isn't going to balance because we don't have cash. And for the cash, like again, as a reminder, this is coming from the source balance sheet where we have the cash plus the short-term and the long-term investments because we're trying to lump together as much of that as possible. And so now we've got to figure out the most important part, which is what is going to happen to the cash here. And in order to do that, we've got to fill out the rest of our cash flow statement down here. And so we already have all the components for this. And so we just need to link them up. And so I'm going to link up, first off, the net income. So this is going to be our cash flow from operations, where we've got our net income at the beginning. Then we're going to add back our D&A, which is going to come from here. And so I'm going to make that a positive because, again, we're adding that back because it's a non-cash expense. And then the change in net working capital, I'm going to link back over to the cash flow statement here. And I'm going to make that a positive number. And so on the over here, you've got to remember, like you've got to be very careful with your signs. Like, is this a positive number or is this a negative number? And the reason that that's a positive number is because, as we mentioned, we are going to have a net working capital decrease on an average basis because we have a lot more deferred revenue than we have anything else. And so the deferred revenue is increasing enough that we're creating cash as we do this business. And so that means that we're in fact going to have cash generation on the balance sheet in this line right here. So that's going to get us our cash from operations. And so I'm just going to sum that up real quick. And we're basically going to have cash from operations looking about like this. And then realistically, the only other thing that we've got here is we've got our capitalized expenditures, our capitalized software, and that's going to get us to our other components here. And so let's just take a second and look back at where we've come. So we've been able to fill out our balance sheet and our income statement, all except for the cash. And so what we're trying to do now for the cash is make sure that we've got make sure that we've got a solid baseline on our cash flow statement to drag back up here into this. And so that's going to be very, very important to make sure that we build out this cash flow statement as correctly as possible to make sure that this flows through appropriately. And so let's look next at the cash flow from investing section. So we've got capitalized expenditures, we've got capitalized software, and total cash from investing. And so on the capitalized expenditure side of things, we actually calculated this over on our income statement, ironically. And so I'm going to take this, I'm going to copy it over for the capitalized expenditures, and I'm going to do the same thing for the capitalized software here. So we're going to take that, we're going to link that over. And then our cash from investing activities is just going to be the sum of these things. And so we're going to take some of these things, and that's going to get us our cash from investing. And then last but not least, we've got our cash from financing. And so this involves things like revolver draws and term loan paydowns and things like that, and total cash from financing. And what we're not going to do is like make weird assumptions about this. We're just going to basically assume that our cash and like our debt situation is a homogeneous, like homeostatic system. And so one of the simplifying assumptions that people make in their financial modeling is that when you take out debt, you pay down debt. And when you pay down debt, you take out new debt to like keep it flat. And so unless you're building an LBO, most of the time you can actually keep these flat at zero. And so that's what I'm going to do now is I'm going to keep these flat at zero. And then I'm going to calculate out the total cash flow from financing as the sum of these. That's also, of course, going to be zero. And then we're going to be able to get our total change in cash, which is the sum of the cash from operations, the cash from investing, and the cash from financing activities. And so that's going to get us through to here. And so what we've got now is we've got our change in cash. And so this change in cash here is then going to flow back up into the income statement. We're going to take this and we're going to put it up here as the change in cash. And so we're going to say the 1.1 plus whatever this is. And some of the dynamics that we're noticing here is that we're basically losing enough money that this is going to go down. Like our net income is negative enough that this is going to go down over time. And so we know that that's going to be a drag on the profitability of the business. And we've got to be cognizant of the fact that if we keep running the business for too long, this unprofitably, our cash is going to go to zero and we're going to go bankrupt. And so this is a very important line to pay attention to. It's at the bottom of the cash flow statement. It goes back up to the balance sheet. But luckily, we see that in the final year, we actually start to generate some of this cash. And so then the last thing that we need to do is check if our balance sheet balances, and we're probably going to need to make an adjustment for the other liabilities to fix the formula that we adjusted from earlier. And so what I'm going to do here is I'm going to basically say this does, or well, I'm going to copy over the matching formula. And we're going to notice that in fact, it's off by the exact same amount every year. And that comes from the other liabilities, where if you remember, it was previously other current liabilities, but then we added in the long-term liabilities. And so I'm just going to trace that formula back where we took basically the 55 million here, and then we added in this 21,808. And so what I'm going to do for the forecast period is I'm basically just going to make a super simplifying assumption, which is that this other long-term liabilities stays flat. And so I'm just going to add that into every previous or every subsequent period such that in fact, voila, our balance sheet balances. It's always the scariest part as an instructor is getting to this point and checking, does the balance sheet in fact balance? Because many times it's very easy to make some mistakes. So let's go through and talk through what we just did. Basically, we started out with the easy stuff on the balance sheet. We linked up the accounts receivable, the other current assets to the cash flow statement. Then we held goodwill and some of this other stuff flat. And then we summed it all together and we knew that because we hadn't filled out the cash yet, that wasn't going to balance. And so we'll come to the cash in just a second again. But then we linked up the accounts payable and the deferred revenue from the cash flow statement and the accrued payroll. That was all easy stuff from the cash flow statement. And the other liabilities was also easy from the cash flow statement because we had the current liabilities, the other current liabilities forecasted as part as net working capital. And then just to make the balance sheet balance, we added in this other 21,808, which was the long-term current liabilities, where or long-term liabilities. We're basically just saying that's going to stay flat. It's not going to change. It's small. It's not a big deal either way. Then for the shareholders' equity, we did the classic retained earnings formula. That's the same thing as retained earnings, shareholders' equity here, where we basically said we're going to take the prior period plus the net income, that's going to be the next period. And that gets us to our liabilities and shareholders' equity total. And so then the key piece that we had to figure out here was what did we do with the cash? Like, how did we get this cash? And that came back to where we went and actually built like a classic cash flow statement. And so we started out with our net income. We added in our DNA. We dealt with our change in cash flow from the cash flow statement. And I'm just going to make these green because, in fact, these are links. And then that got us basically to our cash flow from operations. And so for those of you who were wondering like, oh, where's our cash flow statement? What does that look like? There you go. This is our normal cash flow statement. It's simplified, but it works. And then we built out our cash flow from investing and cash flow from financing sections. And then basically the cash flow from investing was super simple. We just had two line items, CapEx and capitalized software. Those are the parts we cared about. We already forecasted those on the income statement. And then the cash flow from financing, we made as easy as possible for ourselves by assuming that there was a homeostatic like system here where basically as we pay down debt, we raise new debt to keep that equal. And that's a very common assumption in the cash flow from financing section for everything other than LBO models, where you specifically care about the debt pay down and dividend recaps and things like that. And so then we calculated out our change in cash, which is CFO plus CFI plus CFF. And then that goes up here to the top, and we were able to make our balance sheet bounce. So I know that this was a lot and we were moving very fast. So I'm going to pause here for a few questions. How do your balance sheets look? Are they balancing? Or are they imbalance sheets? Yeah, the check is super simple here, where basically all we do is we take the total assets minus the total liabilities and shareholders' equity. And other people, what they'll do sometimes is they'll do an equal sign. They'll say, does this equal this? And like that's fine too. It either goes true or if this, changes, then it turns into false. But I don't like that as much because it doesn't give you the magnitude of the error. And so it's important also to know like how far is it off? Because remember earlier when we had the other current liabilities and we subtracted this out, like we saw that this was 2108. And then I was like, wait a second, I remember that number. We already had that number, and that gave me a lead to figure out why the balance sheet doesn't balance. And so that's why on the check, I like to use a subtraction as opposed to an equals Boolean. Keep the questions coming.
Wait, Max, could you go over like how you adjusted the other liabilities again?
Yeah, it's a great question. So the other liabilities here, basically, we calculated the other current liabilities on the cash flow statement already. And so we had that from this statement over here, the other current liabilities. But if we remember from looking at the actual balance sheet, there were a couple of different types of liabilities. So we had the other current liabilities here, and then we also had this like other long-term liabilities component. And this part's small. It's like 20 million, like not a big deal. We shouldn't be focusing on it too much. And so we said instead of forecasting out the other liabilities separately and having a separate line item for the current and the long term, and the current's way more important, it's like 5 times as big last year. Basically, what we did is we said, okay, we're going to assume that the other liabilities is going to stay flat. And so what I did is I held that flat. I basically linked it to the balance sheet. I said that's going to be 21 million, $22 million for the whole projection period. And then we're just going to add in the other current liabilities that we did project more carefully on the cash flow statement earlier. And then Sahil's asking, could you run through the cash projection? Got the first year projection right, but the rest wrong. So this again comes back to what's going on down here. And so for the cash projection, this is a very complicated one that involves cash from operations, involves the cash from investing, that also includes the cash from financing. And so cash from operations basically is going to be consisting of net income plus your non-cash expenses like DNA. So we kept it very simple. We only did DNA here. And then any changes in net working capital. Under cash from investing, we did CapEx, we did capitalized software. We subtracted those things. That got us there. Then for cash from financing, we did a revolver draw, we did the term loan paydown, and cash from financing. When you sum all of that together, that gets you to your cash and investments. So hopefully that makes sense in terms of how that was built and why that was built that way. But that will get you to the cash. And then I'm going to take these last couple questions and then we're going to move on and spend the last 15 minutes that we have together looking at some of the outputs so you can go and play with them on your own because it's going to be a ton of fun. There's a lot of really cool stuff there. So first off, your net working capital seems to be off by a little bit, but also balances. I have no clue. That's something that we need to look at your model and pull apart line by line to figure out what happens. But if your balance sheet balances, great job, gold star, you're halfway there. And then second, for the check line item, is it to create and send to your higher ups? So in your outputs, that's a great question. So for this check line item here, you would not put this in your PowerPoint. Like you're not going to put this in the PowerPoint outputs. And frankly, you're not going to put any of this in your PowerPoint outputs. On the job, what you're going to do is you're going to create an entirely new tab that's called like balance sheet output or something like that. That's like a totally, and you're gonna spell that right, and you're gonna like actually link this up, and you're not gonna have like the green, and you're going to have like nice spacing, and you're going to, really, really care about formatting, and you're probably gonna like indent these nicely or something like that. So it's very, very easy to read. And then you're going to screenshot that using CapIQ or FactSet or something like that, or ThinkCell, and output that into the PowerPoint. But you're never going to just like take a screenshot of like a random check line in your balance sheet, unless like you're just like doing a very, very quick screenshot for your managing director. But like for an output, especially for a client, you're going to have a separate output tab. And we're just not doing that today because it's a waste of time. It's like, frankly, just Excel grunt work. So with that, I want to spend the last 10 minutes just blitzing through some of these other tabs and leave you with some next steps in terms of thoughts of where to go from here. So we've built the model. We built an income statement. I'll let you figure out the calendarization on your own. When you look at and then we built a cash flow statement, which was an abbreviated cash flow statement with a lot of the basically just the basics that we need to actually succeed in building out the balance sheet. And then we built out our balance sheet. We copied over some of the income statement stuff just to like, have that available. And we built out a cash flow statement proper to make sure that we're able to calculate the change in cash. And then we have our total assets that equals our total liabilities and shareholders' equity. And so basically, this is a three-statement model. And like you should be proud of yourselves if you followed along. And even if you got halfway there, like you've built halfway of a three-statement model and you can spend the rest of the day working around on it, you can figure it out. But what was the purpose of this, if not then to go conduct valuation? And so that's where we get into these next sections, the outputs. And so the valuation, you're going to see that now our football field theoretically should populate. It looks like the chart's broken right now, but basically this gets us the numbers that we need to say, okay, well, the valuation is going to be somewhere in this range. And then we can go back and go into the P&L and the comps and the precedents and dig into this. And so this is sort of like what I was talking about with like an output tab where we took the P&L and we translated it into a very nice historical and projected period. And so this is going to be something that you're going to do all the time is you're going to take the numbers that you've calculated in your base model and translate them into outputs. Honestly, that's half of modeling is taking the base model and putting it into different formats and like, calculating slightly different things and building a different deck and like presenting it in a different way for a different managing director, yada, yada, yada. It's like, it's a pain in the butt sometimes, but realistically, once you have the core model done, the outputs go pretty quickly. Then for comps, let's talk through a little bit about what we would do next here. So these comps here were collected for you from FactSet and public filings. And so realistically, the ways that you would find this is you'd go into BAMSEC for each of these businesses, like we talked about at the very beginning when we were collecting filings, and you'd go and you'd figure out what their cash is, what their debt is, what their fully diluted stock price is, and calculate out the market value. And so that would basically go, it would be something like this. You'd want to figure out what the basic shares outstanding are. Then you would add in the RSUs, you'd add in the TSM stock options, and then you'd have like the converts, and then you calculate then the share price, and that would get you like your fully diluted shares outstanding, and then you do the share price, and that would get you to like your equity value. Then you'd figure out what the cash is and the short-term investments plus the long-term investments that are liquid. Then you'd figure out the debt and the non-controlling interest and things like that. And then you get to your enterprise value. And then for each of these businesses, you would then go pull the revenue and the EBITDA for historical and forecasted periods. And so honestly, modeling, spreading comps is so time consuming. It's one of the most time consuming components of modeling is because like basically you have to do a miniature version of what we just did for one company for like 20 companies. You have to like go and like actually figure out like what is the EBITDA and like what add backs do we have? And is it on a calendar basis? Is it in the right fiscal currency? Like, how do we adjust this? And how do we make sure that everything ties on an apples to apples basis? And then, you'd go and you'd do the actual calculations here. And those are pretty simple. Like, where basically you could take the enterprise value, you could divide by your EBITDA, and you get the EBITDA. Now, in this output, we hard code everything just because we don't want to share the backups on all of these. But that could be another really great thing to do, is to try and spread the comps and try and replicate what we've done here. And then growth, margin, you probably know how to calculate that. And so the fundamental thing that we're getting from this table of comps, though, is what valuation implications does it have? And so the things that we really care about, like I was saying, are the mean and median revenue multiple on a forward-looking basis usually, and EBITDA multiple on a forward-looking basis. And so we went and did all this work on comps to create 4 numbers here. And frankly, honestly, you could get away with 2 of them. Like, you could just pick the means or something like that for each of these. And then that would get you a pretty good valuation range. And then going back over to our football field, what we did is we took those multiples. We took the 75th percentile and the 25th percentile, and we pulled those from the comps to basically give us a range of what the valuation for our business Sentinel-1 could be. And so we said, okay, so if the 75th percentile is 9.5 times revenue and the 25th percentile is 4.5 times revenue, then that means that our business is probably somewhere in that range. And so we can figure out what that's going to look like in terms of like the valuation range. And I think that this might be a little bit messed up. So don't rely on this football field too much. I think it's like a little bit backwards, but that gets you the concept. Then for the precedents. And basically what we have here is we have a bunch of different deals where we did the same thing. And then we did ServiceNow, we did Francisco Partners, we did Palo Alto, we did Google. And so how you would do this is you'd go into CapIQ or FactSet and you'd run a screen. And so you'd say, okay, like, I'm going to go look for deals that are, somewhere less than 20, $30 billion revenue or enterprise value, and over $1 billion of enterprise value. And they happened within the last year or two, and they're broadly related to cybersecurity. And then you're going to go and calculate the revenue and the EBITDA. Now, this is also very hard. Similar to spreading a comp, spreading a transaction comp, like a precedent transaction, is really difficult because it requires you to deeply understand what data is available, what data is not available, and how to aggregate it. Because the reality is, for a lot of these deals, like I think this Francisco one was private, like I mentioned earlier. And so finding the multiples is going to be challenging. Like, they might have released it in a press release. Someone might have gossiped about it online somewhere, but you've got to get scrappy about looking through all the filings you can and talking to bankers and talking to other people to try and figure out what the multiples are on the deals that are most relevant for you. And if you only have a few of them, then it's not going to be a very good range. Like in this case, we only have 5 of them. Realistically, I'd like to have 15 really comparable deals that we can triangulate what the multiples would be based off of what they look like. One other thing that you'd see on a more advanced precedence output is something like the margin and the growth rates or something. And that's going to be really important because, similar to comps, how can I tell if Sentinel is more common to or more similar to CrowdStrike or to Qualys? Like Qualys here, they've got 6% growth rate. CrowdStrike has a 20% growth rate. You know, which one's it more similar to? Well, probably CrowdStrike. And then similarly, though, it also has like a massive unprofitability, and a lot of these are really profitable. And so if you don't have like the profit margins and the growth rates, it's very hard to determine if the comps and or the precedents are going to be really good comparable entities. So I'll let you take a look through those, but I know you all are itching probably to look at the DCF. So let's take a look at this, and I would encourage any of you who are feeling ambitious to go ahead and delete all of these numbers, delete all this good stuff, and build it from scratch. Now, I'm not going to do that right now. Right now is what I'm going to do is I'm just going to talk you through it a little bit. So for the discounted cash flow analysis, the first thing that we did was we forecasted out the unlevered free cash flow. So many of you could probably rattle off the formula. It's EBITDA minus D&A to get to EBIT, and then you take 1 minus the tax rate to get to your NOPAT, and then you add back the non-cash expenses like D&A, subtract out the change in net working capital, the capital X, the software expenditures, whatever. That gets you to the unlevered free cash flow. You can go reverse engineer how we did that, but hopefully you know the formula. And then once we got the unlevered free cash flow, we had to discount it back. And so you can see how we did that, but we used the mid-period convention. And we have a toggle up at the top where you can go back and forth and you can play around with what that looks like. We took the mid-period convention and we used a WACC based off of this on the right. And you can see where all this data came from. But for our WACC, we did the tax rate, 21%. We don't have any debt, so we didn't calculate a cost of debt. We took the risk-free rate from a treasury website right here. And then we took the equity risk premium from a report called the Duff and Phelps Guide, which has since been purchased by Kroll. And so realistically, you should just know that it's about 5% right now. And I wouldn't worry about that. I would just literally copy that for now. Then the beta you can get from CapIQ, from Yahoo Finance. There's a lot of public sources. In general, I recommend a 5-year beta. In this case, it's a 3-year beta, which doesn't quite match up with the time frame of our DCF, but it's close. And then because they don't have any debt, we didn't have debt per capitalization in terms of the steady state. And so you can go dissect our WACC formulas, but we discounted back the cash flows. And then we calculated the terminal method using the perpetuity growth rate method and the exit multiple method. And so in each of these cases, you can back into the formulas. But like I was mentioning right at the beginning, there is an element of market dynamics in especially the exit multiple method. And so when you're doing these, be very careful to understand that a DCF, although it's technically intrinsic, is not fully intrinsic. And so coming out of this session, there are 3 things that each of you should be doing to make sure that you're going to succeed in technical interviews. The first of which is to go back and try and understand the things that you didn't understand. Take the concepts that we discussed today that you weren't comfortable with and go study the theory. And so this is something where you should be on like Ask Stanley and you should be on the 400 question guide and you should get our technical cheat sheet from the website and like say, hey, maybe I didn't really understand networking capital as well as I thought I did. Or maybe like the DCF theory that Max just ran through didn't make a ton of sense. And so if that's the case for you, then like go back and relearn that. And I recognize that we were probably moving way too fast for some of you today and maybe a little bit too slow for others. But for those of you who like felt a little bit overwhelmed or something like that, like this is a learnable skill. You're not too late to learn it and you can get there. And then the third thing that I would say is for those of you who aren't already working with us in the program, like we can help you get up to speed. And so if any of this was interesting to you, you want to learn more, or you didn't feel like you got enough content or enough instruction on these things, like please do get a call with our team. Like we'll help you talk through the strategy and we'll be able to help you understand how to build financial models like this more effectively. And I'm regularly hosting boot camps and webinars like this. On Wednesday, we've got a session on sophomores in investment banking recruiting called Sophomores, Are You Too Late for Investment Banking Recruiting? So go sign up for that. Go keep an eye out on our website for additional webinars in the future. And so with that, I hope that each of you have a great rest of your day.